quality of the S&P has actually improved.
The valuation, yes, it's high, but it's justified in our minds.
Businesses are still in a really, really good spot.
Corporate America has a lot more difficult decisions to make this quarter.
It's not all easy. I think this is going to be somewhat messy in this reporting season.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday at all-time highs, the Mag 7 putting together 9 consecutive days of gains ahead of earnings. The Treasury Secretary, Scott Bessent, pushing for a review of the Federal Reserve, and quarterly results from General Motors expected to highlight the impact of trade policy. Those numbers 30 minutes away.
To me, earnings take center stage this week, and it's not just the tech earnings, as you just pointed out. It's also GM. It's also Coca-Cola. Remember MAHA, Make America Healthy Again, and the potential for sugar to be used rather than refined corn syrup. There's also this question about Lockheed Martin and how much orders are coming from overseas. That also is coming this morning, the second biggest week for earnings that we're going to be getting.
For me, it's all about GM, because the 25% levy on the auto sector still exists right now. What we heard from GM back in May was that they were going to try to mitigate the tariff impact, about 30%. But the CEO, Mary Barra, wouldn't say whether or not any of that would be passed on. So how have they been able to do it? They did come out and say that they were going to invest more in the plants in the United States. Was that just to assuage the concerns of this administration, or do they actually do it, and is it helping?
The numbers drop at 6:30 Eastern time. For many of us, we're just reheating an old story. The narrowness of this market, the dependence on a handful of stocks to drive this equity market to fresh all-time highs.
Which is the reason why people are so interested in Alphabet and Tesla tomorrow. I will say, Verizon, the most boring of boring companies, fascinating yesterday. It came out with earnings. And some of the non-tech companies have been so interesting because they highlight the one big beautiful bill and how much that's padded their earnings out with an understanding of just what tax advantage they'll get with capital expenditures. These are the types of things I'm watching to understand exactly how broad-based this could be or whether it stays super narrow.
There's a word that's come up a few times in the past week, clarity. When you spoke to Scott Kirby, clarity. We saw that from Delta Airlines as well. The word clarity. Have they got the clarity they need to invest again for the back half of this year? And do they expect consumers to have that very same clarity to spend?
You're hearing that pretty much across the board. I mean, yes, there are certain places that are highlighting weakness, particularly in the lower income sectors. But otherwise, pretty much across the board, you are feeling a greater sense of certainty. It has come from the legislation passed in Washington, D.C., but it also comes from this perception that there is a ceiling on how high the tariffs could potentially be. And that's the reason why I think it's really interesting to see whether there's perhaps an overcomplacency around where some of these trade talks go.
I'm struggling with clarity right now out of Washington when it comes to trade talks. Howard Lutnick says that the deals will be done by August 1st, and that is a hard deadline. But you have the Treasury Secretary continuously leaning into this idea that a rush deal is not as good as a good deal. They want a good deal rather than a rush deal. And he said this when he left Japan. And then what did we have very late last night? The Japanese trade negotiators sitting down with the Commerce Secretary. This was the Japanese negotiators' 8th trip to Washington, D.C. to try to get a deal over the finish line. Can they get this done by August 1st? And even if August 1st comes, so the Howard Lutnick said it's a hard deadline, the Treasury Secretary seems to think things are a little bit more fluid and flexible.
One official doubling down on deadlines, another official de-emphasizing deadlines, and the press secretary saying that maybe you could have some trade letters going out before the deadline. You up to speed?
This is the reason why people are ignoring it all. What's the point of even trying to keep track of the tally when they're just basically talking against each other? And it's all one big negotiation, and this has been moved many times before. I mean, what did we learn from TikTok? Oh, that deal, that was 90 days.
It's a rolling 90 days.
It's a rolling 90 days. I mean, it seems like trade as well.
Record highs in the equity market. Equity futures this morning down about 0.1%. Coming up this hour, we'll catch up with Matt Miskin of Manulife John Hancock Investments, with stocks coming off all-time highs. Terry Haines of Pangaea Policy as Treasury Secretary Scott Bessent calls for a review of the Federal Reserve, and Bloomberg's Craig Trudell on earnings from GM about 25 minutes away. We begin this hour with stocks stalling after hitting another all-time high as investors await big tech earnings and President Trump's next trade deadline. Joining us now to discuss, Matt Miskin of John Hancock. Matt, welcome to the program, sir. Just how fragile is this record-breaking rally?
We're right back to where we were at the beginning of the year, John. It's an extended market with really multiples hitting on at least the 4 PEs back to about 22.5. You know, the highest in history is 24. So high yield spreads are down to 280. The best, tightest ever is 230. we're looking at the riskier parts of the market. They can't get much better than this. And you can get that carry, you can get the earnings growth. That is something we are looking for here, but it's going to be hard sentiment-wise to crank up the dial anymore on risk taking. And in our view, now's a good time to go around a portfolio, prune some risk, find some places that are extended. And for us, it's some of the momentum factor in the United States and, frankly, some of the European financials that have had an amazing start to this year.
So, Matt, you're not going to get away with just saying that and moving on. Talk to me about the financials. That has been the big winner of 2025. Why prune those gains now?
You know, we've seen a steeper yield curve here as it's been nirvana. You've had basically a central bank, at least in the European Central Bank, they've been cutting rates. And now we're hearing opening the fiscal floodgates is the term we're hearing. And really, this is globally around the world. You're seeing governments say, I'm not going to fight the tariffs one-on-one. What I'm going to do is I'm going to take on more debt and I'm going to stimulate my own economy to basically fight the economic ramifications of this. And really, that is creating this huge rush into more cyclical parts of non-U.S. equities. China equities are on fire this year. European financials are doing exceptionally well. It is a very counterintuitive market. You hear all these tariff headlines, and then you see Chinese equities doing exceptionally well. We're trying to mitigate politics in portfolios because it's not happening like you would think. But in our view, you've had a great run. It's a great time to take some profits.
Which raises the question, what isn't expensive? What isn't overvalued? If you're coming back to the United States, well, we just hit, I believe, our 12th record high on the NASDAQ, our 10th record high of just this year for the S&P 500. What's to say that it's not overvalued in the United States?
It is, Lisa. And really what we're going back to is boring old bonds. And we are getting about a 5% yield on high quality corporates and mortgage-backed securities. 5% to us is a great yield. And lo and behold, if yields even come down a bit, if the Fed does cut at the end of the year, we think that's actually more total return potential. If we even get what we got on the first half and the back half, we could get high single digits out of bonds. We think that's a lower volatility option. We're increasing certainty in portfolios by driving income versus looking for more capital appreciation through multiple expansion. We're not going to the 30-year Treasury in case you're going to ask me that next. But intermediate part of the curve, relatively high quality, income producing assets look attractive to us here.
Matt, you've been conservative over the past few months, and this has been a market that's been anything but conservative. You see the FOMO trade starting to come back. How hard is it to stick to this kind of conviction of going long into bonds at a time where the riskiest parts of the market keep outperforming?
Yeah, having quality has not been a great strategy this year. You really wanted to dip into the most frothy, lowest quality parts of the market. And this does happen, Lisa, over time in market cycles. And what we've seen time and time again over this market cycle is that this is usually a shorter term tactical type trade. And this one is a longer one. You know, the last 6 months, it's really been still this kind of trade. But I mean, in April, it certainly felt better to have higher quality assets. In our view, it's going to come back into favor in the back half. We actually see a decelerating growth environment, decelerating inflation environment. And already you're seeing in earnings. You just talked about this. Who's at the top of the earnings growth? It's tech, it's comm services. These are high quality parts of the market. And then in the bond market, I hear you, credit spreads have been grinding tighter. But how much more tight can they go? And even in investment grade corporates, we're keeping up with high yield. We think that's actually pretty impressive given how risk on this market's been.
Matt, when it comes to some of the uncertainty out of Washington, a lot of investors coming on the program are talking about the concern of Fed independence. Yesterday, we heard from the Treasury Secretary calling for this review. Are you concerned he's calling for a review of the Fed, or maybe relieved that also in this tweet, he's emphasizing the jewel box of monetary policy, which is Fed independence?
Yeah, I never had it on my bingo card that I'd be reading Bloomberg articles on the construction of the Fed building for 2025. But here I am. You guys have some great articles on it. I'm like, okay, is this really what I'm doing, though? I don't know if this is going to lead to any changes in monetary policy. I think even if you have someone else that's there, they're going to be using the same data and looking at the same things, and they're going to tell you that basically they're going to have to be on hold for the most part. And what they're missing, in our view, is that housing is slowing. And that, to us, is going to take time to show up in the data. And by then, they're going to be behind the curve almost naturally. And so we do think they should be cutting more so, or more likely to cut here than not. But all this goes back to the currency markets. Currency rules everything around markets in 2025. The bond market's not really caring that much about this, frankly. It's the dollar that is against the ropes, and the dollar coming down is creating this risk-on impulse. And that's actually leading to more risk-on trades around the world. And it's just a very counterintuitive domino effect than what you would think, given this uncertainty around the Fed.
So, Matt, just finish on that. It's an important note. We've seen a recovery in credit. You talked about the tightness of spreads. We've seen a recovery in the equity market. We talked about the leadership there. Why haven't we seen the same recovery in the US dollar?
Yeah, I mean, it's very counterintuitive. We're looking at interest rate differentials. Even yesterday, John, I mean, the European yields were tumbling. The European short end was falling more than the U.S. short end. No one cared. The dollar got crushed. And why was that? Well, that was right around the headlines that hit about more investigation around this building, more investigation around the Fed. And so the currency markets are the ones that are most sensitive to the change in maybe the Fed or basically all the uncertainty around Powell. And really, it's about a capital story flowing to Europe because of this uncertainty. In our view, this is a very tactical thing. This is a sentiment-driven thing. And it could come back, but the dollar technically has just gotten annihilated this year. It's been against the ropes, like I said. I think the sentiment is overdone. The hate is overdone. In BofA manager surveys, it's the most negative on the dollar in 20 years.
Yeah.
To me, that's a good place to look for a contrarian opportunity. But I got to see the technicals turn because it has just been a tough year for the dollar.
A very crowded trade. Matt, appreciate your time. Matt Miskin there of Manulife John Hancock Investments on the Federal Reserve. Later on this morning, 8:30 Eastern Time, Chairman Powell.
Yeah, and he's not going to be talking about any of this except that everyone's going to be looking for him to talk about this and really rebut the idea that there has been this mission creep. And I'm glad that Annmarie brought that up. Everyone's focused on the renovations, but what Scott Bessent said yesterday I thought was really interesting about a full investigation into mission creep that compromised its independence, not having to do with monetary policy, kind of raising the specter of exactly what the gripe is that this administration has with this Federal Reserve.
A conference on financial regulation kicking off a little bit later.
Sounds scintillating.
This morning. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Joining us now is Yahara Anand. Hey, Yahara.
Good morning, John. Treasury Secretary Scott Bessent is calling for an exhaustive review of the Fed's non-monetary policy operations, including renovations to its headquarters in Washington. In a post on X, Bessent says that significant mission creep may be jeopardizing the independence of the central bank's core mission to set monetary policy. Meanwhile, trade negotiations are continuing ahead of President Trump's August 1st deadline. Press Secretary Caroline Leavitt told reporters more countries could receive tariff letters before then. Trump is set to meet with Philippine President Ferdinand Marcos Jr. at the White House today. And BlackRock is restricting the use of company devices in China. In an internal memo seen by Bloomberg, the world's largest asset manager told staff to use temporary loaner phones and not to bring company laptops when traveling to China. This coming after a Wells Fargo banker and U.S. government employee were blocked from leaving the country. That's your Bloomberg Brief. John?
Yahara, thank you. More on that story later this hour. Up next on the program, Chair Powell in the hot seat.
The Fed chair needs to lower interest rates. The president is right about that. And finally, people are catching up to the president on that.
Up next, Terry Haines of Pangaea Policy. Live from New York City this morning. Good morning. It has been snoozy. 18 consecutive sessions without a 1% move in either direction. Alex Semenova here at Bloomberg saying that's the longest such streak so far in 2025. Futures this morning, negative 0.1%. On the Nasdaq 100, we're down about 0.2.
Yeah, but in that boring morass, we've had 10 record highs on the S&P 500 and 12 record highs on the Nasdaq. So the most exhausting and sleepy sort of grind new highs that we've ever seen, maybe. But here we are.
It's a welcome snooze. I wasn't complaining.
Yeah, I know. You keep threatening fate. This is an everyday occurrence.
I'm not doing that at all.
You're totally doing this.
It's a nice summer Tuesday.
People in the newsroom were cursing you yesterday. They were like,
they?
John had to say that. He's absolutely foiled us.
And what happened? Absolutely nothing.
Okay, good.
Just a
there
nice summer Monday, hopefully followed by a nice summer Tuesday. Under surveillance this morning, Chairman Powell in the hot seat.
He has no plans to fire the Fed chair, but he has been very transparent in expressing his displeasure with Jerome Powell's management of the Fed and also his policies. If you look at our country, by every economic metric right now, it is booming. Look at inflation, like I said, continues to go down. He's basically defeated it in just 6 months. By all accounts, this is a good economy. The Fed chair needs to lower interest rates. The president is right about that. And finally, people are catching up to the president on that.
Here's the latest this morning. The pressure on Fed Chair Jay Powell unrelenting. Secretary Besson now calling for a review of the central bank, warning of, quote, mission creep and institutional growth. Bloomberg's Akela Garda joins us now for more from Washington, D.C. Akela, welcome back. What is the direction of travel here? Where are we going with this?
Well, you just heard the White House press secretary say yesterday that the president has no plans to fire Jerome Powell. But we already know that. He said it himself. He's left the door open. Still, that keyword plans there to potentially doing that. We know this administration is looking into this Federal Reserve renovation project. But something that happened yesterday is Congresswoman Anna Paulina Luna made a request to the Justice Department accusing Fed Chair Jerome Powell of lying under oath when he testified to Congress in June. Now, it's important to say the Fed Chair says that he has been consistent with his testimony that he gave to Congress last month, and the DOJ isn't compelled to necessarily investigate this, but we still have yet to find out whether they will. But as you mentioned, Treasury Secretary Scott Bessent says he wants to see an examination of the entire Federal Reserve institution and whether or not they have been successful. But there's really two camps of thoughts here in the Republican Party. You have the likes of Senate Majority Leader John Thune, who's really concerned about the independence of the Fed and whether that could have a negative market reaction. And then you have people even like Speaker Mike Johnson, who have said that he believes interest rates should come down based on the direction of the economy. But at the end of the day, this Fed chair's term is up in May 2026, and President Trump says he's only going to be looking at people who want to lower interest rates. On the list is also Bessent, also Kevin Hassett, the chief economist to the president. And so if he picks someone from this administration, they are more likely probably to side with his viewpoint here.
Will the president wait until May 2026? We'll see. Akela Garda down in Washington, D.C. Akela, thank you. Let's extend the conversation with Terry Haines of Pangaea Policy. Terry, good morning and welcome. A couple of lines from the Treasury Secretary, Scott Bessent. Mission creep, institutional growth. Terry, what's he getting at?
Good morning, John. I'll add one more, which is internal, as in internal review. What Bessent is calling for is the Fed to look at its own non-monetary policy regulatory operations and assess those, assess whether there's been mission creep, assess how best to focus. So this is really, indictment is too strong a word, but it's it's a suggestion to the Fed that what they need to be doing is taking a look at their non-monetary policy operations, firstly. Secondly, it's a not so subtle dig at Congress, I think, because what you have is a situation where Congress loads a lot of these non-monetary policy functions onto the Fed generally. And, the Fed hasn't done this in a quarter century or more, so it's past time that they do it. And I think Bessent is making a nod in this direction politically, in part because he's trying to be helpful, firstly, but secondly, he's counseled Trump that in a week, particularly where you've got earnings, you've got tariffs coming up, and you've got gold going up, this is definitely not the right time to be shaking the markets with Powell.
Akela mentioned Representative Anna Paulina Luna and her referral of Powell to the DOJ. Does she have anything in common with what the Treasury Secretary is asking for?
It's what I found interesting about Luna's letter to the Justice Department. Firstly, I think it's a stunt and it doesn't go anywhere. But secondly, by looking at the Fed headquarters and the building operations, what she's bringing up, wittingly or unwittingly, is the idea that governors other than Powell are involved in this. And, Powell himself said once before he was chair, he was the administrative governor, meaning looking over the Fed's physical operations. That's done by other governors right now, and I think the three of them are Biden appointees that were confirmed by the Democratic Senate. And what Bessent's looking at is kind of beyond Powell. What are the governors up to? What's the governors generally up to? Why are they involved in mission creep? And strangely, that's the kind of thing Luna's bringing up in her own complaint too.
So, Terry, are you saying that this criticism we see right now on Jay Powell could potentially expand to other individuals at the Federal Reserve?
I think that's entirely possible. I mean, look at the criticism that Trump launched against then Vice Chair for Supervision Barr, that resulted in Barr being replaced in that post by Governor Bowman. So this is not new for the White House, firstly. Secondly, you had this dovetails a lot into the mission creep comment by Bessent dovetails a lot into what some candidates, I think particularly former Governor Warsh, have been talking about when they say that we need regime change at the Fed. They're not talking, Kevin's not talking about, only changing out Powell in that regard. And we need a different approach to Fed policy generally. That goes beyond Powell. So I think we're looking at more of the composition of the governors here generally. And again, I think Barr's a precedent in that regard.
What's the goal here? I mean, given the fact that we've heard from the president for quite a while that he doesn't want to fire Jay Powell, he does think he should lower interest rates, but he's probably going to. Right now, the Fed's on path to cut rates by 25 basis points twice for the remainder of this year. Mm-hmm. Why are we hearing about this from every hall of every congressional corner right now in every iteration?
Oh, I think most, by the way, I think most people in Congress are hiding out from this. I don't think they want any part of this. But what Trump's up to here is, first of all, Powell's somebody to blame. Everything's going swimmingly, as you heard Carolyn Levitt say in your intro piece, and everything's going great. That there's only one fly in the punch bowl, and that's Powell, who's Mr. Too Late, Mr. Not Getting It, all the rest. Beyond that, I think what they want is they, being not just Trump, but people like Bessent, people like Governor Warsh, for example, are talking about a new and different sort of partnership where policy goals are more aligned. Even though the Fed is independent, policy goals are more aligned in kind of a Fed Treasury alliance than they are with the Fed as some kind of free-floating de facto fourth branch of government. I think that's the longer-term game here.
There is a conspiracy theory that part of this and the Washington Commanders or Redskins and getting renamed, and last night the dump of Martin Luther King Jr. files is all a distraction technique. Do you just shrug that off as being irrelevant, or do you think that there's something to that?
I think the presidents at the apogee of their power exercise as much as they can, however they can. Trump reminds me, in this one regard, reminds me nothing so much as Theodore Roosevelt a century plus ago, running around doing everything from strong-arming the Panamanians into building a canal to rewriting the rules of American football. So, that's very much in Trump's character, and he frankly sees the opportunity to do it. And if somebody tells him, is there a potential hook through which I can exercise some influence, he tends to take it right now. 2 years from now, maybe not so much.
Terry Haines of Pangaea Policy. Terry, appreciate the update. Thank you, sir. On monetary policy and central bank independence, of course, of the utmost importance for a lot of people. I get all that. It doesn't mean the institution should be beyond criticism, both on the monetary policy failures of the last several years and on the regulatory failures as well. I get that Wall Street loves the individual leading the central bank right now. A lot of people on Wall Street love Chairman Powell because they've made a lot of money. But there have been some serious failures over the past few years.
And a lot of academics have talked about it. A lot of economists have pointed to it. And people could argue that the inflation that we did see, the surge post-pandemic, was in part because this Federal Reserve did not raise rates quickly enough and then failed to really respond in any kind of material way. Look, there are real criticisms. The question is, what is the ultimate goal, and does it compromise the perception of independence?
Got some good news for you.
What's that?
We can talk about something else.
Yes.
Up next on the programme, we can talk about earnings. Earnings from GM just around the corner. Plus, we'll catch up with Danny Berger with your morning movers as M&A heats up. 9 straight days of gains for Mag 7 stocks. It's a stellar run. Longest winning streak going back to November 2023. Equity futures this morning negative by about 0.1%, pulling back from all-time highs on both the S&P and on the NASDAQ. With 3 hours into the opening bell, let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. The railroad operator CSX gaining in the pre-market 4.5%. This is off the back of a report from Semaphore that Berkshire Hathaway's BNSF is looking at acquiring one of its rivals. It's hired Goldman Sachs to do so. It's not clear what exact company it would be looking at, but really the only options are CSX or Norfolk Southern. So those shares are gaining this morning. Now, at the same time, we had earnings from NXP. This is the Dutch chip maker, though listed here in the U.S. And it seemed that it was a disappointment when it came to their outlook for the next quarter. Half of the company's exposure is to the automotive industry in terms of where they sell their chips to. So some real stress there in terms of supply chain issues when it comes to tariffs, costs there. Also slowed down EV demand, shares falling nearly 6% this morning. Finally, Open Door. It's a relatively small company, but I wanted to bring this one up because it would seem as if the meme stock trade was back. Someone tweeted on X, which made its way to Wall Street Bets, something positive about the company. Maybe it's not important what they actually said, but the important thing is that this thing yesterday surged 121% at one point. In fact, the trading was so heavy that this individual stock made up 10% of all equity trading yesterday. It is gaining again in the pre-market, up 13%, giving some of those 2021 meme stock vibes, John.
A massive move, that's for sure. Big reminder of way back then. Danny, thank you. Danny with the latest movers. One more for you. Numbers from GM just dropping moments ago. It's a beat on the top and bottom line. The initial number 253 on EPS for the second quarter. The estimate 233. The team's going to run through the details. We'll come back to that story in a few minutes' time. On our radar this morning, Treasury Secretary Scott Bessent is calling for a review of the Federal Reserve, warning on X, quote, mission creep and institutional growth risk jeopardizing the central bank's independence towards monetary policy.
So I keep coming back to what's the goal, because we keep hearing, and Caroline Leavitt yesterday said that the president has no intention of firing Fed Chair Jay Powell. Now it's expanding out to other potential appointees, as well as some of the other initiatives that have been pulled back at the Federal Reserve. Is the goal to change the composition? Is the goal to have a scapegoat? Is the goal distraction? Is the goal something else? This, to me, is more important possibly than even some of these missives, because the market's largely shrugging it off at this point as just ongoing noise. Unless you get some sort of real pushing out of Fed Chair Jay Powell, does it really move the dial?
Not shrugging it off right now, though, is the Federal Reserve. They put out yesterday a 6-minute, 23-second video detailing all the refurbishments that are needed and the renovations that are needed, basically saying how office space expansion at the rear of 1951, an atrium of this 1951 building, going through why they had to use specific plaster when it comes to making sure they're up to par with government regulations. They are doing their best to try to get ahead of this because they know this is going to continue and definitely going to continue into May of next year.
Next week, tomorrow, there's a Federal Reserve meeting, and it could break in a rather dovish fashion. In that statement, in the first paragraph, they say labour market conditions remain solid. Well, we know Governor Waller doesn't share that view. Others might not either. So you could see a change in the language there, and much more of a dovish bias start to be built into the Federal Reserve as we work our way through the summer. So I think we always have to take a step back with this conversation. Yes, the White House wants rate cuts. No, the Fed is not delivering them right now and might not next week either. But the gap between where they want to be and what the Fed's about to do is not that large. The Federal Reserve is about to cut interest rates. There's a dovish bias. They're probably going to cut in September. And at the moment, the data is breaking in that direction.
But this is the reason why I say why now? Because ultimately, they're undermining their own argument. If you overlay that potential rate cut with some sort of political motivation, you're undermining the economic case that so many economists are making. So at what point are you're shooting yourself in your face, you're cutting your nose off to spite your face kind of thing. I'm mixing metaphors. It's a Tuesday.
It's a quiet Tuesday.
It's a quiet Tuesday, and we're talking about renovations. I just keep going back to that. What is their ultimate goal?
We're still asking that question. I'm just going to answer with all of the above. All of the above.
I'm sure you're right.
Let's move to this story. Commerce Secretary Howard Lutnick meeting with Japan's chief trade negotiator Monday evening in Washington. According to Japan, the pair had in-depth discussions aiming towards a mutually beneficial agreement.
So this was the 8th trip of the trade negotiator to Washington, D.C. to have these formal discussions. It also comes on the heels of the Treasury Secretary going to Japan for the World Expo, to his words. But come on, he met with the Prime Minister Shiba, and they're trying to get this deal to the finish line. And when he left, he put out this tweet that I think was really important because it goes against what Howard Lutnick's tone has been, which is August 1st is a hard and fast deadline. People can, of course, call, but that's the deadline. The Treasury Secretary said a good deal is more important than a rush deal. And this gives the sense that they're willing to give trading partners that are in these in-depth discussions a little bit more time if they're not done by the deadline.
If there was a league table for getting a deal done with the United States of America a few months ago, Japan was top of the league. The EU was bottom of the table. We've seen a complete reversal in the past few months.
And what happened? An election. And this is something that we increasingly have to look at. The domestic ramifications from the increasing trade tension and how much that is affecting some of the more populist bent that you're seeing in a number of countries, as well as what the cost will be to pay for some of the requests coming from the White House internationally.
A lot of tension between the US, the White House and various trade partners. A lot of tension with China. Take a look at this. BlackRock restricting the use of company devices in China. According to an internal memo seen by Bloomberg, employees were told to use loaner phones and leave company laptops behind while traveling to the country for business.
My question was, were they actually still using their real phones in their corporate laptops before? Because pretty much everyone who I've talked to who goes to China on a business trip ends up using burner phones and burner laptops. It just heightens this question of how do you do business in a country that you can't get a concrete sense of what the rules of the land are and whether you could potentially be used as a chip in this sort of tit for tat between the U.S. and China.
I was shocked when I read this story because in 2021, we saw new laws come out of China that tightened data security. And anyone that goes to a country like China, like Iran, like Russia, like myself, you don't bring personal phones or personal laptops into these countries. That is standard operating procedure. So it's just so confusing that they've only decided to do this now. And I wonder who else is out there not actually going in with burners, because they should probably take a look at that when it comes to compliance.
We all had the same reaction to this story, I think, when it broke. That's the latest on BlackRock and China. Here's the latest on GM. Earnings dropping just moments ago. Joining us now is Bloomberg's Craig Trudell. Craig, the stock is lower by 2.65%. Have we just put the price of tariffs coming from the White House?
Yeah, this was a company that I think took a lot of people off guard when they announced earlier this year as much as a $5 billion hit to their bottom line as a result of tariffs. And it sort of, your initial reaction to that is, wait a second, this is an American company that builds a lot of cars in America. That is true, and yet they also build a lot of vehicles in Canada, in Mexico, in South Korea, which a lot of people, don't have a sort of full appreciation for. And the extent to which they're going to have to sort of shake up their production network to account for the fact that these tariffs, may or may not stay in place. I think to this point, we've seen Mary Barr really sort of take the Trump administration at its word that we are not going to go back to the way it was. And so, this is a manufacturer that, as of last year was going to build electric vehicles at one of its plants in Michigan. It's now going to build big combustion pickups and SUVs there, and that will allow for more production of big SUVs down in Texas. So, kind of pulling back a little bit from its transition to electric vehicles and kind of battening down the hatches because of just how impactful these tariffs are going to be.
There's some bad news and some good news this morning. The bad news is that net income declined 35% in the second quarter of this year compared to last year. The good news, Craig, is that a lot of analysts and investors have priced a lot of this in. I just want to understand whether the underlying business is receiving the kind of demand that's reflective of an economy still doing okay.
Yeah, I think it's fair to say that. I do think that there's some real concern about just how much kind of pull forward demand this industry saw ahead of tariffs hitting. We've talked a lot about, Taco and Trump chickening out. This is one sector where he has not in any way sort of chickened out or pulled back. There's maybe been some incremental relief for the industry, but these are tough duties that car makers and their suppliers are facing. And it's one where, when Trump talks about ways in which, in his mind, the U.S. is being taken advantage of, it's kind of the sector that he jumps to first. And so I think, executives like Mary Barra and her peers are sort of, rethinking, just how likely it is that they're going to be able to sort of negotiate substantial relief from this White House.
But Craig, I was under the assumption that if you're USMCA compliant, at least with Mexico and Canada, you're not facing that 25%. So where exactly are the tariffs hitting?
Yeah, there are complex mechanisms with how exactly trade is going to change between partners, and I don't think that we can necessarily take for granted that there may be some changes to that. Of course, when we renegotiate USMCA, which Trump has made quite clear that he's not happy with where things stand there. I think the Korea element of this is a substantial portion. But there's also just, real sort of change, again, in the production network. These moves that the company is making sort of on a dime to go from, making EVs in Orion in their assembly plant in Michigan to now making, pickups and SUVs there. That costs substantial money, and that's investment that needs to be made now in order for production to start, 2 years out from now. And so we're going to see some of those hits to companies' bottom lines now, even if we don't necessarily see a substantial change in what's coming out off the assembly lines for some time.
Craig, I'm just wondering if we can glean anything from this earnings report for tomorrow and what we hear from Tesla.
Yeah, I think GM, sort of quietly, sort of under the radar, had a heck of a second quarter in terms of EV sales in the U.S. They've roughly doubled their sales. I think, Tesla, of course, is still very dominant in the U.S. EV segment, but that is a segment that really has a lot of dark clouds hanging over it, given what the Trump administration has done and is doing. The Big Beautiful Bill didn't just take away tax credits for EV purchases. Republicans also zeroed out penalties for not meeting fuel economy standards. And we know that one of the big sort of sources of revenue for Tesla over the years has been not from selling cars, but from selling regulatory credits to other manufacturers who haven't made enough EVs, haven't sold enough of them, and need help with meeting these rules that are now going to be watered down and, more or less done away with. And how much is that a drag on Tesla beyond some of the factors that get more attention, which is, the potential damage that Elon Musk is doing to his own company's brand?
One thing that we saw with the financials was we saw them cross pretty high hurdles and their stock sales sold off. We're seeing GM shares lower by 2.3% in the immediate reaction. It's not necessarily the final one. But these numbers, as John was mentioning, were pretty good in a number of ways. And their estimate for the year ahead was pretty much in line with what they had said before, an estimate. So is this just a matter of expectations being really high, or just the fact that people have soured on this name and don't think it's tradable right now?
Yeah, I mean, I think we've actually seen, some relief in this sector. Our very own Esha Day had a great story to begin the week about how car stocks have actually gone from, getting beaten up pretty good to coming back a little bit. So we may, we may be seeing that there's a bit of a sort of higher bar in order to kind of keep and maintain those gains. But we also should, keep in mind, just yesterday, to your point about the sort of final verdict, remains to be seen. Stellantis, we saw really ugly numbers out of them yesterday, and that was a stock that went from down substantially early in the day to finishing up. And so I think there's a lot of sort of grappling with, the extent to which these impacts are lasting, maybe some willingness to look past the fact that these are adjustments that, these companies have no choice but to make. And GM, I think, is in a much stronger position than a lot of its peers in terms of, still continuing to make substantial money off of its trucks and SUVs in the U.S. and the demand for those is still extremely strong. I think they're also making some progress in turning things around in China. They're not getting back to where they used to be, but they're no longer losing money on a sort of quarter-by-quarter basis, and that's an important development to keep an eye on as well.
Hey, Craig, appreciate the update. Thank you, sir. Craig Trudell, Thank you very much. Craig alluded to it. Lisa said it too. As we often say on this programme, the first move isn't always the right move, but this is the first move. We're down about 2% on that stock in the pre-market. The headline from the earnings story from General Motors just moments ago, tariffs on foreign-made vehicles and parts chopping $1.1 billion from adjusted earnings.
And probably going to increase over the third quarter when some of the other tariffs come into effect, mitigating it, though, potentially by increasing prices and other measures out there, also pointing to the fact that they do expect electric vehicles to still be a profitable and bright spot in their sales, despite the fact that we have seen a pretty big policy shift on that front.
Equity futures more broadly doing OK. We're down about 1% on the S&P with an update on stories worldwide. With your Bloomberg brief, back with us, here's Yahara. Hey, Yahara.
Hi, John. We start with a recap of GM earnings. GM shares are falling nearly 2.6% in the pre-market. The company reported second quarter profit that beat Wall Street estimates, but fell short of a year ago. That's because, as you mentioned, John, President Trump's tariffs on foreign-made vehicles and parts chopped $1.1 billion from adjusted earnings. Though, here's the bright spot. GM maintained its full-year forecast for earnings. Meanwhile, a new report says President Trump's tax and spending law will add $3.4 trillion to U.S. deficits over a decade. The latest estimate from the Congressional Budget Office also warns millions will lose health care coverage. The analysis doesn't factor dynamic effects like its potential impact on growth or interest rates. And shares of Lindt are falling in Swiss trading, dropping by the most since early 2022 after the chocolate maker's earnings missed estimates. Lindt also reported weaker than expected volume growth and earnings as it faces soaring cocoa prices. Shares had been up 35% year to date through Monday. That's your Bloomberg brief. John?
Not a fan. Yahara, thank you. Never have been a fan.
This is my
Don't
shot
like that
face.
soft-scented chocolate.
You like Laderack.
I like Laderack.
It's a bit more
There we go.
expensive.
Yeah, exactly. And
Just
also,
slightly more expensive,
Are you
but for
kidding?
special occasions.
Slightly?
Special occasions.
Okay, it's also pure
Go in
chocolate.
store, they'll give you some samples, walk away, come back for more later.
You guys are the worst. You go in there, you're like, hey, we're back. They're like, oh, here they come again.
No, they love us going in there. They don't rub their eyes. They give us the free samples. What are you talking about?
But we are consistent customers. So that's why they give us the free samples.
For free samples.
No, and we're paying.
And we buy on special occasions.
But a large cocoa component is good. Hyper milk content tends to be a little bit sweeter.
Well said. There we go. Up next on a program, struggling to find a floor for the US dollar.
If the Dow cannot pick its head above its, let's call it mid-June levels, that for us suggests that at least in the moments, the dollar is still going to be a tailwind. The bias towards a lower dollar is likely intact.
That conversation up next with Sam Zief of JPMorgan Private Bank. From New York City, you're watching Bloomberg TV. Record highs on the S&P 500 and the Nasdaq 100 coming into Tuesday, pulling back just a little bit this morning. We're down 0.1% on the S&P, down by 0.2 on the Nasdaq. Under surveillance this morning, struggling to find a floor for the US dollar.
The fact that you still have the dollar consolidating, that suggests to us that if the dollar cannot pick its head above its, let's call it mid-June levels, that's a level that we have not seen been able to surpass in about 4 or 5 weeks, of course. That for us suggests that at least in the moments, the dollar is still going to be a tailwind. The bias towards a lower dollar is likely intact.
Here's the latest this morning. The dollar facing a series of tests over the next week or so, including the July Fed meeting and August 1st tariff deadline. Sam Zief of JPMorgan writing, despite signs of US economic resilience, we expect further declines in the dollar over the medium term. Sam joins us now for more. Sam, good morning.
Good morning. How are you?
What are the pillars of this dollar weakness view?
Yeah, so there's really two main ones. One, cyclical convergence. The U.S. labor market is still loosening. The Fed, we can argue when it's going to happen, but it's probably over the next couple of meetings going to start resuming interest rate cuts. And most of these other major central banks, the ECB or anywhere else, have kind of finished a lot of their cutting cycle. So we do expect some cyclical convergence there, some convergence between growth and interest rates abroad. And then second is a global asset reallocation story that's continuing. So global investors, we're not seeing any signs of liquidation of U.S. assets. You know, there's hyperbole around. There's none of that. But we're definitely seeing incrementally less inflows into the U.S. And when you set it against a backdrop of a U.S. with a very, very large trade deficit, a very large current account deficit, it needs those inflows just to offset the depreciation pressure on the dollar. So the more that you just see incrementally less inflows into the U.S., we think the bias for the dollar is to leak lower.
Let's address each point individually. 2 points. The first one, rate convergence. The pushback there would be that Europe is facing a disinflationary shock, and maybe America is facing an inflationary shock, and the rates profile is going to be different because of that. What's your counterpoint to that?
My counterpoint to that is when you look at real interest rates and inflation-adjusted interest rates, then as the Fed starts to cut, even in the face of a slightly higher inflation environment, which is probably warranted given the labor market loosening, your real interest rates decline. And that's the convergence that we're expecting. Maybe not so much in nominal space, but real, and that's what's going to allow the dollar to weaken.
To the second point, the pushback would be that you aren't seeing necessarily outflows from the United States, and you're still seeing quite a bit of allocation to U.S. dollar-denominated assets. People are just hedging more, which is leading to a weakening in the dollar, but not necessarily any sort of reallocation away from the U.S. What's the counterpoint to that?
Well, you're right. I think for the dollar, it doesn't really matter which one it is, right? If you think about a global institutional investment fund, let's say, the first thing they're going to do is raise those FX hedge ratios, which they've allowed to decline in recent years, and that puts selling pressure on the dollar. And then as the assets that they own mature, they decide to undergo an asset reallocation. That's the next leg. And so, yes, I do think immediately what's been happening is an increase in FX hedge ratios. The next way that it continues is that asset allocation story continues. Either way, it results in a slightly weakening pressure on the dollar.
How does the Fed independence story fit in with the potential weakening of the dollar further?
Yeah, I mean, it's not a pillar of our view, but if you set it against the backdrop where already investors are demanding some more compensation to finance the U.S. fiscal deficit, to finance the current account deficit, then this just adds another risk to forcing investors to demand more compensation to that. So it doesn't really factor into our direct baseline forecast, but pushes downside risks to the dollar outlook.
So at the moment, do you think all this criticism is just noise?
I think our view, honestly, has been it doesn't really matter who the Fed chair is. They're one vote among 12. But the perception of the Fed's independence is crucial to thinking about the right value for the dollar or the value of long-term Treasury yields.
So in that respect, who they appoint to be the next Fed chair for May, when Powell's term is up, is important.
In the signal it sends over how political the Fed might be, honestly, what that person's view is on monetary policy probably doesn't actually matter all that much. You need to convince the entire committee to either lower or increase interest rates.
How close do you think the committee is right now to reducing interest rates?
Yeah, I think in the next couple meetings, it's going to make sense. I think what's interesting about the debate over Fed independence, again, I won't come in one way or the other, is that if the call was 50-50, then honestly, it's probably incrementally slightly harder to cut interest rates just because it's been couched in such a political environment. But I do think either way, over the next couple meetings, we think that there's 50 basis points of cuts this year and probably 50 basis points next year.
Does it concern you that your call is very consensus and that there is a lot of bearishness right now priced into the market with positioning against the dollar?
Yeah. On a medium term, no, because fine, maybe fast money players, hedge funds, CTAs had gotten very short dollars, although honestly, I would argue over the last week or two that some of that's been cleaned out. But the medium-term story, the asset allocation story, the increase in FX hedge ratios, these are funds, these are players that take a long time to make these decisions. I know from speaking from our clients at the private bank, they are having more of this conversation than we've probably ever had before, and still it's a slow-moving process to move from your current asset allocation to another.
Could play out over years, not just weeks and months.
No.
That point to me was really salient, this idea that we've seen the hedging, but that's the first step. The second step is the allocation shift. And that's what I think a lot of people are very dismissive of by saying, look, the numbers don't show it right now, so it's not going to happen. Doesn't mean to say that that actually won't happen down the line.
Sam, strong defense of your call. Appreciate your time. Thank you. Thank you very much. Sam Zief there of JPMorgan Private Bank on the weak dollar call. The bias is still for this Federal Reserve to cut. What happens if that bias isn't doubled down on in the next few meetings? Then we're going to have a very different situation down in Washington, D.C.
In terms of a more aggressive tone, if possible, from the White House. I mean, I'm not sure exactly how to extrapolate that out, but it's not going to be pretty.
Select a new Fed chair. Maybe someone already on the committee.
Yeah.
Get that shadow Fed chair activated.
Yeah. I mean, at a certain point, how much has become a liability for the Fed if they really don't get more done?
Then you start pricing in their views for 26 anyway, regardless of what Chairman Powell is saying.
Lots of fun for the next couple of
We
months.
achieve the same thing.
Yeah, it's going to be fun.
Up next on the programme, Victoria Fernandez of Crossmark, Sarah Bianchi of Evercore, Adam Posen of the Peterson Institute, and Russell Brownback of BlackRock.
The economy has proven quite resilient.
What we're really waiting for is this pass-through of inflationary impact.
Inflation will be transitory.
I really don't know that we're at the cusp of something dramatic happening to this economy.
This economy is supposed to slow down this quarter. We think it actually won't be as sharp a slowdown.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures on the S&P coming off all-time highs, down 1/10%, off record highs on the Nasdaq 100, down by 0.2%. This week is all about the earnings and a sprinkle of economic data. Tomorrow, numbers from Alphabet and from Tesla. This morning so far, from GM and from Coca-Cola.
Yeah, we just got Coca-Cola earnings that also beat expectations. The operating margin I thought was really interesting, came in at almost 35% versus the estimate of 33%. We can get into all those numbers. To me, this sums it up. James Quincy, CEO, amid a shifting external landscape in the second quarter, the ability of our system to stay both focused and flexible enabled us to stay the course. This is what we keep hearing from corporate America time and time again.
Heard it from the banks, heard it from the airlines, hearing it from Coca-Cola this morning, from GM. The good news is that it's better than estimated. The bad news is it's worse than last year, and it's worse than last year because of the tariffs. The price is here. Tariffs on foreign-made vehicles and parts chopped $1.1 billion from adjusted earnings.
They are eating that on their margins. You are seeing their profits really get cut by this. But going forward, this means that they're going to be cutting costs pretty much across the board. And that, I think, is what everyone's going to be looking at. How much has become the norm going forward where there is increasing corporate cost cutting?
And are they going to have to raise prices, which is why the call is going to be so interesting. What does the CEO say about going forward, especially as clearly they are talking to this administration? The 25% levy on autos still exists, although if you are USMCA compliant, how much of that is being passed through? Are they going to have to pay on some of these products but not others? But Craig Trudell brought up a great point. A lot of these parts as well come from South Korea. They are not USMCA compliant, and that potentially could be one of the more expensive expenditures they have.
Bring production home is the message coming from the White House, and maybe they will. That's a story to track, not for this quarter, not for the next year, but the next several years. Big headline just crossing. Kinda. From Coca-Cola. Plans to launch an offering made with, guess what? U.S. cane sugar. This is what we expected to see from the company. This is the headline that's just dropped.
Well, we heard this from the president over the past few days. He said last week, President Trump said that Coca-Cola had agreed to sweeten its signature soda with cane sugar in the U.S. And not high fructose corn syrup. The company came out and said, we weren't familiar with that. We haven't done that yet. Now they are coming through with this. This really puts a lot of pressure on the sugar market. I'm very curious to see the potential ramifications there.
I want to know if Trump forced them into doing this today, because he came out with that statement, or already were there talks in the works, potentially a little bit of both. But they plan to do it. They're going to make it with cane sugar. This, we have to note, is actually a win for the MAHA movement, Make America Healthy Again, and RFK Jr. We saw it as well when it comes to products from the ice cream makers and cereals.
Stock is up in the pre-market by 0.8%. Equity futures this morning lower by not even 0.1%. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark following fresh all-time highs. Sarah Bianchi of Evercore ahead of President Trump's August 1st tariff deadline. And Russell Brownback of BlackRock seeing compelling opportunities in fixed income. We begin this hour with stocks trading near all-time highs. Victoria Fernandez of Crossmark writing, this doesn't mean you should jump in with both feet as valuations appear stretched and sentiment is becoming extended. Victoria joins us now for more. Victoria, welcome to the show. I want to get to some of your calls. Financials, industrials, tech, three groups that you quite like. And we want to understand, what does that look like if the growth inflation mix starts to sour in the second half of this year?
Yeah, well, when we're looking at the market, we obviously want to be in there and taking advantage of movements in the market. But what areas are going to be where we want to put money to work if we do have a more stagflationary environment like you're talking about? And we know that there will probably be a steeper yield curve. And we've seen loan growth actually start to increase, a lot of that because of the ramifications for the reconciliation bill, right? If you have a boost to CapEx, a boost to non-residential construction. So we think financials can play well there. Tech tech just continues to take leadership, and that trend continues to be higher. And so we think that will probably continue, especially if AI is the area where we're seeing a lot of that CapEx be put to work. And in industrials, especially those industrial metals, kind of ties in to that as well, that non-residential construction, that CapEx component, having that onshoring come in. Those are all themes that we think play out in those areas, but it's not just that there's themes for them. Those three areas are in solid uptrends and they have solid balance sheets. And so those are things that are important to us when we're looking where to invest.
Victoria, you said it, the earnings might hold up. How does the multiple hold up in the face of a steepening yield curve?
Yeah, it's really tough right now. I mean, we look at this multiple that we're seeing, and it is quite stretched. I mean, we're 23, 24 times next 12-month earnings. That seems really steep to us. Earnings is what have actually held this current environment up. It's what's allowed the consumer to continue spending. So we are concerned about earnings. You know, we're scheduled to do what? Low, middle single digits here this quarter on EPS growth. That's going to be the lowest in about 1.5 to 2 years. If corporations can't hold those margins up, y'all were just talking about the margins from Coca-Cola. We saw margins go down with GM. If they can't hold those margins up, then I think you start to see some of that flow through to the consumer, and you see that weakening in the economy. And I think the cyclicals that are now outperforming defensives, that will start to rotate and you'll have to shift.
So talking about Coca-Cola, and we're not going to ask you about cane sugar and your preference between cane sugar and
love
high fructance.
Mexican Coke, Lisa.
I know, that's right.
Mexican
a lot
Coke.
of people seek out the Mexican Coke because it has cane sugar. Now they have to do that no more because it's going to be offered here in the United States. Coke actually said that they did beat estimates in part because consumers did absorb higher prices. And I wonder how much you're starting to see this, but instead of a weakening in the economy, actually the strength of people absorbing it and saying, thank you, can I have another?
Yeah, I think a lot of it is just going to depend what we see in the labor market. You guys know that I've thought the labor market has been a little bit weaker than what the numbers have been showing. There's these underlying cracks in the labor market. They're not widening tremendously right now, but those cracks are there. If the labor market weakens more, and I do think we're going to see some of that coming in end of third quarter, beginning of fourth quarter, because a lot of the government layoffs, those severance packages run out in September. We're going to see some more weakening in the labor market. When wages start to really slow down, then I think you're going to see people go, wait a minute, how secure is my job? Maybe I start to pull back. Right now, they're not feeling that pressure. So they're willing to spend more and pay more for the things that are important to them. I think we could see that change in the fourth quarter.
Going forward, what are you looking for to really understand whether there is some sort of weakening in the economy? And if there's not, is this sort of feeling that the Fed is going to cut rates in the near term sort of counterintuitive, given the strength that we're seeing and on the margins, some inflationary pressures coming in a number of consumer-facing companies?
Yeah, the Fed is really kind of interesting right now because you have such this wide variety of views. I mean, you look at Waller saying we need to cut in July, right? You have Daly saying, oh, we're okay for right now. You've got Kugler saying, no, we're good for, where we are for quite an extended period of time. So there's many different views, and I'm not sure we can actually pinpoint what the Fed is going to do, even though it looks like September might be the first rate cut, just I think to get ahead of some of the weakness we could be seeing in the fourth quarter. But it really comes down to those margins and the earnings. If corporations continue to show that and consumers are willing to pay a little bit more, then it's going to hold the economy up. And I think we will be able to have maybe 125 basis point cut just so the Fed can say they're not behind the curve, that they're looking at things and they want to help, juice things up a little bit. But again, it is counterintuitive. If we're doing so well, why do we need to cut it all? Are we really that far above neutral? That's the question.
So you say the Fed's waiting for margin and earnings, but what about the tariff rates? Or have you given up on policy in general? Lori Calvasino was with us earlier in the week, and she talked about that they've just removed their attempt to quantify the policy backdrop for stocks this year because it's so uncertain and it keeps changing and it's very fluid.
Yeah, it is. I don't think you can, take your pen and put something into your outlooks in regards to tariffs. Well, the way that we're kind of looking at is saying, what are some offsets? And, is that going to be one for one? We don't know. But offsets to some of the effects of tariffs are going to be some of the benefits from the reconciliation bill that people think will be coming to fruition. I think that's why the market keeps moving to all-time highs. They're seeing some of these benefits. They're seeing some of the hard data look a little bit better. weekly claims, industrial production, retail sales, and they're thinking, okay, there's enough benefit coming out of the reconciliation bill and better hard data to offset what we're going to see coming out of the tariffs. They're kind of weighing that scale right now, and they have them somewhat equal. If one side starts to outweigh the other in the near future, then I think we can see the market shift.
When you say benefit of the one big beautiful bill to certain parts of the market, what industries are you thinking of, Victoria?
Yeah, I think it's going to come back to kind of what we were talking about in the beginning. You're going to see industrials do better. I think you will see financials do better, again, because you'll see a steepening of the yield curve. You're going to see some of the elements that are in there that will continue to do well for the economy in regards to construction. So I think those are areas that you can continue to see growth.
Victoria, stay there. Just stay close. I just want to bring in these comments from Mohammed Al-Arian, who just posted this out on social media. Reads as follows. This morning, US government criticism of both Federal Reserve Chair Jay Powell and the institution itself has broadened to include mission creep and the effectiveness of other officials. The developments of the last few days reinforce my view. If Chair Powell's objective is to safeguard the Fed's operational autonomy, which I deem vital, then he should resign.
This goes to something that a number of academic groups have really pointed to, which is there have been signals of mission creep along the way. And right now, this administration is highlighting it in a highly political moment. But this is something that a growing number of people really do believe has been a problem and part of the reason why inflation was allowed to pick up as much as it did. So there is legitimacy and sort of pockets of questions in some of what the administration is saying. How it's being perceived by markets, though, is an entirely political patina, given some of the other commentary.
Mohammed goes on to say, as to the market reaction, most of the frequently mentioned candidates to replace Chairman Powell would be able to calm any potential market jitters. Victoria, can I just ask you, what would happen in your mind if we did get the outcome that Mohammed is suggesting?
Yeah, I'm not sure that it would actually calm the markets that much. I actually think it might give us some increased volatility and maybe actually see yields move a little bit higher, which I know is counterintuitive. But I have to think that if you have someone come in that's appointed by Trump, people automatically think that they're going to lower rates. But you're going to have a Fed that is probably going to be against them. The other members of the FOMC I don't think are going to react well to having that happen and to have Powell resign. And he's going to have, the new person will have to have the support of all those people to get a rate cut done. So I actually think we might see more volatility in the market in the beginning if Powell was to resign.
Victoria Fernandez of Crossmark. Victoria, thank you. Just to repeat what we just heard from Mohammed Al-Arian, if Chairman Powell's objective is to safeguard the Fed's operational autonomy, which I deem vital, his view, he should resign.
What I find interesting is that last point as well, to the market reaction about these candidates that have been mentioned, they would be able to calm any potential market jitters. Victoria says no, but we have been talking about someone coming into that job if Fed Chair Jay Powell was fired. What Mohammed is saying is if he resigns and then one of these people come in, then you are still keeping that Fed independence because Jay Powell himself is taking himself out of the equation instead of the president of the United States.
He also says, I recognise this isn't the consensus view, which favours him staying until the end of his tenure in May, nor is it the first best, which is simply not attainable. Yet it's better than what is playing out now, which I find interesting. Growing and broadening threats to Fed independence and will undoubtedly increase should he remain in office.
The idea of just take yourself out of the equation, let the central bank keep on doing what it does. This actually, according to Deutsche Bank strategists, just to the point of what markets do with any type of ouster or anything that's perceived as an ouster. Strategists Matthew Raskin and Stephen Zhang yesterday said the potential ouster of Fed Chair Jay Powell would lead to a 30-year yield rising by at least half a point. So by more than 50 basis points in response to that. At this point, can you get some sort of graceful exit stage left, even if it is ostensibly on your own volition, given some of the noise that really has come around this?
If you wanted a question to ask in the news conference a week tomorrow, quote that and ask the question. See what Chairman Powell's response would be.
I love it. The cheat sheet from John Ferro. If you want to, know what to ask.
Just throwing that out there.
Yeah.
Dear Michael McKee, if you want a question, I can just send Mike an email later and see if he wants to ask
I think that a lot of people would be curious of the answer.
I'm sure Mike's got something better. Equity futures right now in the S&P, just about unchanged on the S&P 500, very close to record highs with an update on stories worldwide. With your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. We start with the latest from Coca-Cola. It reported second quarter sales growth that beat analyst estimates as consumers continue to pay high prices for its soft drinks. The company also raised its full-year growth outlook, and Coke confirmed that what President Trump said last week, which is that it will launch a new product made with cane sugar this fall. Meanwhile, the Trump administration says it's deploying more immigration agents to New York after an undocumented migrant allegedly shot a federal officer. Homeland Security Secretary Kristi Noem blames the city's sanctuary policies for releasing repeat offenders, while New York officials say they follow state law and are targeting dangerous individuals in coordination with federal partners. And Malcolm Jamal Warner, the actor who rose to fame as a child star on The Cosby Show, has died. Warner drowned while on a family vacation in Costa Rica. Authorities said in a statement that Warner had apparently been swept away by a current and that bystanders tried to rescue him. Warner was just 54. That's your Bloomberg Brief. John?
Tragic. Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, 10 days and counting.
The August 1st deadline is just the start date for when the United States of America will begin collecting this revenue from all of the countries around the world who the president has sent these letters to. You could see some more letters before August 1st. You could have some more trade announcements as well.
We'll get the latest in the nation's capital with Bloomberg's Akeda Gardner. She joins us next, live from New York City this morning. Good morning. Quite a run for equities for the stock market stateside and worldwide. Equity futures this morning just a touch softer, weaker, lower, down by not even 0.1% on the S&P. Earnings season picks up. Tomorrow afternoon, you'll hear from Tesla, you'll hear from Alphabet. As we kick off earnings season for the Mag 7. Mag 7 names, 9 straight days of gains, the longest winning streak of the year so far. This equity market is doing okay, even if it's driven by just a handful of names. In the bond market, let's talk about fixed income. 2-year, 10-year, 30-year. I want to have two different conversations here. What's happening at the long end and then what might happen at the front end. The long end this morning, yields higher by a basis point or two, 439.37. Yields on 10-year bonds falling for 4 consecutive days coming into today. The focus on debt, not just in America, but worldwide. The UK making some news earlier this morning.
Yeah, this is something that people are watching as potentially you have governments that are trying to plug the gap at the same time that their growth has been slowing down. We've seen the UK face these issues. We've seen Europe on the margins, although they're not as indebted. And then you see Japan. This has been really one of the themes. It's a global bond market, and we've seen that in a massive way.
This death spiral that you find yourself trapped in. Growth starts to go down, tax revenue falls, and what you end up doing, you start talking about more tax hikes. What happens? Growth starts to go down, tax revenue falls. What happens? You start talking about more tax hikes. That's a spiral you want to try and escape, and it's a spiral that the UK risks falling into.
And one of the things that a lot of people have noted, yourself including, is that this is the spiral of developing nations, not of the developed world. And you start to see that type of dynamic really affect the developed nations world, or is the UK somewhat different? If the U.S. finds itself in a situation where growth is actually slowing substantially and it does face some sort of reckoning on the fiscal space, which it isn't yet, do you see a similar type of reaction in the bond market? Not yet, but the UK is a cautionary tone.
EM-type dynamics taking a hold of DM. Here's another example of that. The pressure on Chairman Powell on the future of central bank independence. This from Mohammed Al-Arian moments ago and on social media. If Chairman Powell's objective is to safeguard the Fed's operational autonomy, which I deem vital, he should resign.
This is something that is counter consensus, as he pointed out, and comes as there is a whole bunch of noise around some of the measures that the Federal Reserve has taken. But Mohammed's point here is well taken, which is at a certain point, the discussion, the noise around taking out the Fed chair is counterproductive to the goal of the central bank, and some of the other potential nominees would do a pretty good job. So why not just usher them in?
It's going to be a busy 2 weeks for the Federal Reserve and for the trade story as well. Under surveillance this morning, 10 days and counting.
the trade team and the president himself continue to be very engaged with countries around the world when it comes to our trade agreements. The August 1st deadline is just the start date for when the United States of America will begin collecting this revenue from all of the countries around the world who the president has sent these letters to. You could see some more letters before August 1st. You could have some more trade announcements as well.
Here's the latest this morning. Countries lining up to strike trade deals ahead of President Donald Trump's August 1st deadline. Commerce Secretary Howard Lutnick meeting with Japan's chief trade negotiator Monday evening in Washington. Bloomberg's Akela Gardner joins us now for more. Akela, help us work through this issue. Annmarie was talking about it earlier on the programme. You've got one official in the White House, part of the cabinet, turning around and saying, don't worry too much about these trade deadlines. What matters here is a good deal, not a bad deal done quickly. We hear from another official that says it's a really important deadline. We're going to get lots done. And then another official saying you might see letters sent out before that deadline. Which one is it?
Well, right now, August 1st is the deadline in which they're saying that they're going to begin to collect tariff revenues. But as they've said many times in the past, they're still open to negotiating beyond August 1st. So even if those tariffs go into effect, they're saying countries can still keep calling the phone and ringing President Trump. But something that you mentioned there was those meetings yesterday with Japan. That was the 8th round of trade negotiations for Japan. And Japan is one of several countries who have been negotiating with the administration for months and yet still saw a letter from President Trump simply setting their tariff rate. It was about 25% that President Trump has set it out. That's up only 1% from April. And a lot of countries are starting to digest that the White House and the president himself has not changed his mind when it comes to the level of tariffs that they're going to see. It's not much different from April, despite the fact that we've seen this pause. But some of the countries that I'm watching still, India is a country that the White House and the administration continues to say that we're expecting to seal a trade deal sometime soon. The EU is also pushing for a deal this week and preparing for a possible no-deal situation where they could potentially retaliate. But as we saw with China, which did retaliate very early on in this trade war, saw their tariffs exceed up to 100%. And so there is huge risk for the EU there. And China is another country that is expected to negotiate beyond that August 1st deadline because they have their own separate trade agreement. Secretary of the Treasury, Scott Bessent, is someone who is expected to meet with Beijing sometime early next month.
Yeah, and he told us, don't worry about that China deadline on August 12th. Akela, we do have the president of the Philippines sitting down with President Trump today. Caroline Leavitt alluded to trade is going to come up in the conversation, but the Philippines thinks potentially they could secure a deal. What are you expecting out of this meeting today?
Well, the president has been saying that he believes the tariff rate that the president has floated at 20% is very severe. He is one of many countries that wants to see that lowered. But really his challenge today is to simply get through this Oval Office meeting. We've seen time after time foreign leaders come to the White House and have these confrontations with President Trump. So a lot of leaders simply come in wanting to leave that meeting unscathed. And I'm sure that's the same goal that President Marcos has today at the White House.
Akela Gardner with the latest down in Washington, D.C. Akela, thank you. The trade deadline fast approaching. We're still trying to figure out who's paying for the tariffs. Andrew Hollenhorst of Citi with this to say. Tariff costs will be absorbed by either foreign exporters, domestic firms, or consumers. A modest increase in consumer prices suggests that so far the cost is being absorbed by firms and not consumers.
In other words, this isn't going to be inflationary, at least longer term. He said corporate earnings could hold some clues, and on the margins, we're seeing some companies absorb it in their bottom line. We're seeing that with GM. You're seeing others marginally increase as prices. We're seeing that with Coca-Cola. But either way, the sort of broad-based nature of who absorbs them is leading to Andrew Hollenhorst's team, who has been arguing the Fed should cut rates because inflationary pressures are not the preeminent concern.
He's going to join us at 8:30 Eastern time. And as you said earlier this morning, repeatedly, I think, maybe GM numbers this morning speak to this kind of theme.
Well, the idea that GM did not pass along price increases yet, we'll find out exactly what they do, but they are planning cost cuts. And that raises a question of weakness in the back of this rather than some sort of inflationary push. I'm just struck by how each sector is completely different. Coca-Cola able to raise prices because it's just a can of Coke. But for a whole car, it's kind of a different story. And I think that you're seeing it in these pockets that aren't necessarily a consistent story.
Can of Coke with cane sugar.
I know.
Just around the corner. There we go.
Get excited. Is that Make America Healthy again? Is that healthy?
It's healthier than the
return of traditional Americana.
Hold on a second. You would not have a can of sugar.
I will have a can of sugar.
No, he said he's going to try that.
On a special occasion.
Or is that the cane sugar?
But not a can of
Do you know what's not healthy? Diet Coke, and that's what the president drinks.
You tell him. Up next, Adam Posen of the Peterson Institute with the pressure building on Fed Chair Jay Powell. Futures negative, down 0.1% on the S&P, down by close to 0.2% on the Nasdaq 100. Mentioned this stat earlier on in the program, comes from Alex Semenova of Bloomberg News. 18 sessions now without a move of 1% or move in either direction, the longest such streak of the year so far. Things are a lot quieter. You can measure it in various ways, but things are a lot quieter in this market than they were a few months back.
It just shows that the more volatile the headlines sometimes, the more people just get this sort of numbness. Because what you saw in the first Trump term was actually volatility went really low. And you're seeing something similar in effect, yes, maybe because things have quieted out, but also because how do you make bold moves when you don't understand what the parameters are?
Then it blew up in 2018.
Well, that's true.
Fun and games. Fun and games. Equity futures right now in the S&P then negative by not even 0.1%, very close to all-time highs. Your morning movers are lined up with Danny Berger. Hey, Danny.
Hey, John. Definitely seeing some move when it comes to individual companies off the back of earnings reports. We heard from GM in the last hour. We have the figure for the tariff hit. It is $1.1 billion. Beyond that, though, they saw things like EV sales doubling. They also maintained their full-year outlook. And to be clear from GM, we had already learned from them that they estimated that their full-year tariff impact would be something like $5 billion, but just shows this market's willingness to punish companies that are outlining what the tariff impact will be. We also heard from Coca-Cola a very muted reaction from them. Initially, shares were higher when they reported, but they've just ever so slightly started to sink down. They did beat on multiple fronts. They also were able to maintain and beat on margin, showing that they're able to pass through cost increases to their customers. They also announced a new launch per the president's request, a Coca-Cola that has cane sugar. But again, we talked about the bar being low for earnings season. Even a company that beats still isn't rallying off the back of it. Though I will say one company that is rallying off the back of their earnings is Northrop Grumman. We're getting a lot of the defense companies reporting today. Those shares are higher by 3%, a beat and a raise. Specifically, the president's 2026 budget request appears that it will have a lot beneficial to Northrop Grumman. Their missiles, RBC noting that their B-21 program seems like it will have a double of funding. And just a reminder, this company's B-2 bombers were used in the recent Iranian campaign. So a lot of demand there with geopolitical tensions, John.
Hey, Danny, thank you. Appreciate the update. On our radar this morning, let's get back to GM. Second quarter profit taking a hit due to the president's tariffs, levies on foreign-made vehicles and parts, chopping $1.1 billion from adjusted earnings.
Potentially that could increase in the third quarter because the ramifications haven't been fully felt or weren't fully felt in the second quarter. Some key questions for the earnings call that I think we have to ask. How much is consumer demand going down just from the broader economic picture? 2, electric vehicle sales and how much that's going down as a result of policy change. But number 3, are they going to raise prices? Are they going to cut costs? Are they going to cut jobs? How much are they going to bring back to the United States? This is going to be really at the epicenter of so many trade discussions, just simply because the auto manufacturers have been consistently at the center.
And that supply chain, when it comes to the auto sector, is globally so intricate, so integrated when it comes to where they're sourcing parts, whether it's South Korea, Canada, Mexico. And this story is not going to end for them. Over the weekend, the Commerce Secretary, Howard Lutnick, was asked about what's going on with trade between Mexico and Canada. And he said, of course, we're going to renegotiate USMCA. Remember, USMCA was from Trump 1 when he wanted to renegotiate NAFTA. And he says, of course, we're going to try to get more concessions. So for the auto players, this is going to be a story not just for the rest of 2025, but definitely well into 2026 and probably 2027.
This is going to hang over the industry for quite a while, to Annmarie's point. We had a front-loading of purchases going into the tariffs on specific goods, specific items across specific industries. The auto industry was very much one of those industries.
And so at this point, I wonder how long they can hold off before they raise prices. Remember, Ford said that they were going to hold off on raising prices for a while. And then they went ahead. They were the leaders when it came to raising prices. Very curious to see how much that crimped demand and what we hear from them.
GM is down in the pre-market by about 3.4%. On the trade front, White House Press Secretary Caroline Leavitt saying the U.S. remains engaged in talks, adding that the Trump administration could announce more deals or send more tariff letters before the August 1st deadline.
So what's changed? This has been the whole story the entire time. We're going to send the letters when we decide. We saw a drip of them immediately weeks ago. Then they stopped. Then we said we're supposed to get a bunch by or before August 1st. And then the Treasury Secretary coming home from Japan, I can't get over this. A good deal is more important than a rush deal. Basically saying we will give you more time. And what did he say to all of us? market, ignore that August 12th deadline when it comes to China. So deadlines almost don't really mean anything anymore. What is important, though, are you going to have the customs computers adjusted by August 1st? So whatever tariff rate is currently on the books right now, the U.S. will start to enforce.
Self-imposed deadlines. We should keep referring to them as self-imposed deadlines. They can be changed at any time.
Letters. I mean, honestly, you're going to get a letter. It sounds like, again, like a threat. If you don't quit it, you're going to get a letter.
That's exactly what it is.
I know, but it sort of feels a little bit like what kind of teeth are there.
Thank you for your attention to this matter.
There we go. That's the latest on trade. Citi asking its first-year analysts to disclose whether they've already accepted a job from another company. Goldman making a similar move earlier this month as banks look to clamp down on recruitment by private equity firms. A long list of banks is starting to build.
Yeah, although Goldman Sachs learned the hard way that on one hand, you can't just say, please don't take anything. You've got to pledge your loyalty. On the other hand, how do you offer jobs that they actually want and that can compete with private equity? And the key question is, how much are private equity companies still going to look to poach the best from some of the training programs of the big banks? They have to do the work, and then private equity reaps the benefits because it's a more desirable job versus people who want to stay.
The problem I have with this story is, okay, so they're asking you to disclose if you got a new job. Just don't do it. Be bold. What's the worst they're going to do? Fire you? Because then guess what? You have a new job waiting for you.
Get them to sign a contract and a non-compete and give them favourable terms.
Yeah, but that's exactly
to secure them. I mean, isn't that the way this should work?
Why not do the sweetener rather than the stick?
Precisely.
At the same time, I think that to your point, if somebody did that, it looks pretty bad. I mean, you get blackballed in the industry if you promise to do that. So I imagine that there is a reputational risk to not act that way. That said, there could be a better
Don't take my advice, kids.
I'm just saying.
Citi, the latest bank, pushing in that
if
direction.
My kids are listening. Don't do that.
That's advice for your kids?
Well, I don't want them to do that. That's.
Let's turn to tensions between the Federal Reserve and the White House, not just Kaz Abramo. Treasury Secretary Bessent pushing for a review of the Federal Reserve, posting on X, quote, significant mission creep and institutional growth have taken the Fed into areas that potentially jeopardize the independence of its core monetary policy mission. Adam Posen of the Peterson Institute joins us now. Adam, welcome to the programme. I'd love your reaction, not just to that, but also to this. Some comments from our mutual friend Mohammed Al-Arian a little bit earlier this morning who said this: the developments of the last few days reinforce my view that if Chair Powell's objective is to safeguard the Fed's operational autonomy, which I deem vital, then he should resign. What's your reaction to that, sir?
Those comments are not well taken, John. Basically, what Mohammed would incentivize and what others on the same line would incentivize is anytime the president wanted to get rid of a Fed chair, wanted to affect a Fed chair, they would just throw up an enormous amount of noise and pressure, and then that becomes its own justification. Well, they've lost the president's support. The whole point is that you need to be able to operate as chair of the Fed, and the Fed FOMC needs to operate while not being able to ignore the politics. So if you look, you just saw, I'm sure, the op-ed by Bernanke and Yellen talking about this in more general abstract terms, but think about Paul Volcker doing the necessary disinflation in 1985. Well, imagine you go back and look at what the Congress and the president were saying about him then. And imagine then Mohammed or somebody stood up and said, well, clearly it's imperiling the institutional strength of the Fed if they continue to do this despite everyone's objections. The other point I would make is that everything that's been said about the Fed so far about mistakes and now getting into mission creep, which is a more serious issue, isn't about Fed independence. It is about getting a proper mandate and having proper hearings from Congress, not from the executive branch, about what the Fed should include. And the hierarchy of goals for the Fed is very clear. Stable prices and full employment above all else, financial stability. So this is all just a bunch of game playing. I've heard people saying that Bessent and others in private say they're just working the referee and the referee can't fight back. Well, that's no way to think about the most important economic policy decisions in the country.
So now there's a question, Adam, of how much the central bank should be considering the tariff ramifications and how inflationary this is going to be. On one hand, you see an increasing number of corporate earnings that show them really absorbing a number of the tariff impacts on their bottom line. And then you have Scott Bessent just coming out speaking moments ago to media saying that tariffs are bringing manufacturing back to the United States. And we did hear something akin to that from General Motors. What's your take on what the first read is on how tariffs are being sort of borne through the economy?
Well, as you were just having reported, The fact is, Lisa, that three things are going on. First, companies are burning through inventories. That's notably true in the auto industry, and waiting to put up prices until they've burnt through the inventories of the inputs and the final goods they front-loaded. Second, we're now seeing a lot of beige book type documented anecdotes of companies getting ready to increase prices. Second, because of the kind of political climate we're in, and this was mentioned by Danny Berger, I think, in your reporting, that you don't want to be the target. You don't want to be the one to visibly raise prices. The market reacts unless everybody else does, but eventually you have to. So what you end up doing is spreading the price increase across non-tariff goods as well. The third point is the manufacturing one. As Robert Lawrence of the Peterson Institute has published repeatedly, you can get a little bit of gain in manufacturing, but it's just completely cost competitive and uncompetitive to bring back all kinds of things here. And so if you start putting up huge amounts of barriers, eventually, yes, you can create more cars for the US market, but this will be at the expense of the consumer and the expense of the taxpayer. So, and in the end, you will not fundamentally change the US economy.
Adam,
sorry.
Well,
the last... Go ahead. Sorry.
No, I was going to say, I know that you've been pretty against any kind of tariff, and you're very, very much for free trade. And I just wonder if you've been surprised by how benign some of the ramifications have been so far, or is this always how it is at the beginning because of what you just said, because of the bring forward and some of the other sort of more immediate adjustments that can't happen over the longer term?
It's a good question, Lisa. I don't think I know what always happens because multiplying your tariffs by 10 or 20-fold in an advanced economy has not happened in 100 years. So I can't tell you that this is the precedent. I can tell you that this is certainly within the range of where I would have expected lagged effects to take place. So it's not surprising we haven't had huge inflation yet. And as Secretary Bessent has rightly said, the issue is going to be once we get the jump in price level due to tariffs, does that transmit into second round inflation effects? And that's what the Fed has to call. So I think the big surprise more is the amount of deportations, disruption to migrant workers, disruption to immigrant workers, even with documentation, hasn't had as big an effect on the economy as I expected. That's my surprise. But the tariff stuff seems to be about where it should be so far.
Adam, Governor Waller is already saying that he doesn't see a inflationary spiral when it comes to tariffs, and it's going to be only a one price hike adjustment, and potentially he is going to dissent at the Fed meeting. Are you expecting some potential dialogue, debate at this FOMC meeting?
I think Governor Waller sincerely believes what he's saying. And more than that, he has a legitimate argument. If I was in the room, I would be debating the other side. But I think that is a legitimate thing for the FOMC to be debating, independent of political pressure and name calling, Annmarie. And that's where the focus should be. Against what Chris is arguing, and I think Chris got a bunch of things right over the last few years that other people got wrong, so people should take his views seriously. But I think he's underestimating how much inflation expectations have been de-anchored by the last few years. I think he's underestimating how much the problems in the labor market and the tightness in the labor market is likely to give rise to second round effects. I think he's underestimating how much the fiscal policy in the end will be stimulative. And I think he's underestimating how much shortages in particular industries will be very visible and salient for people the way eggs were or a few other things were under Biden. And so that the de-anchoring effects of the inflation we're about to see, or the price level jump, first round, as you rightly put it, about to see are going to be bigger. But this is the debate that an independent Federal Open Market Committee should be having.
This might have been shorter if we just asked you what he got right, Adam. But we'll leave it there. Adam Posen of the Peterson Institute. Adam, appreciate your time, as always. A long list of things that Adam believes Governor Waller is underestimating.
Yeah, and that's one reason why a number of other members disagree. This is an active economic debate. I think it's important to keep reiterating this, which is one reason why a number of people, including Chris Waller, would like to see that active debate on the Federal Reserve when they meet next week.
It's a credible argument. Let's put it that way.
Yes, I think
you can debate it, disagree, but it's a credible argument with the right intent. Equity futures right now in the S&P, negative by not even 0.1%. Let's get you an update on stories elsewhere with your news worldwide and your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Trade negotiations are continuing ahead of President Trump's August 1st deadline. Press Secretary Caroline Leavitt told reporters more countries could receive tariff letters before then. Trump is set to meet with the president of the Philippines, Ferdinand Marcos Jr., today at the White House. Meanwhile, the White House said it would remove the Wall Street Journal from a small group of reporters traveling with President Trump on his trip to Scotland. This coming after the paper published a story alleging the president once sent a suggestive birthday letter to the late disgraced financier Jeffrey Epstein. Trump is suing the paper over the report. And Victoria Beckham is set to start in her own Netflix show this fall. This follows the success of her husband David Beckham's documentary, in which she emerged as an accidental star. Her show will follow the former Spice Girls day-to-day as the creative director of her own fashion and beauty brands. And she told Bloomberg nothing will be sugar-coated. That's your Bloomberg brief. John?
The news you need. Yahira, thank you. Appreciate it. More from Yahira in the next hour. Here's some news you might need. The Treasury Secretary, Scott Bessent, with a new date to meet the Chinese.
Says he's going to meet his Chinese counterpart in Stockholm Monday and Tuesday. So this obviously comes before that August 12th deadline. He told us just last week it'd be happening in a few weeks and finally have a date. What are they going to discuss? Because they seem to be able to get over the hump of rare earths and what's going on with export controls. What is next in this relationship?
Another round of talks between the US and China scheduled for next week. Up next on the program, the big bid for bonds.
There's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market, how to get into the bond market.
That conversation up next with Russell Brownback of BlackRock from New York. You're watching Bloomberg Surveillance. This headline just dropped in moments ago from the Treasury Secretary, Scott Bessent. Another round of talks between the United States and China, meeting Chinese counterparts in Stockholm across Monday and Tuesday. That headline crossing just a moment ago. The price action looks like this morning. If you are just joining us, welcome. Equity futures totally unchanged on the S&P 500. On the Nasdaq, down by not even 0.1%. That's the equity market under surveillance this morning. The big bid for bonds.
I don't see 10-year yields at 5%. I think they belong at 5%. And that's the great puzzle, that they're not there. That's telling us that there's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market, how to get into the bond market.
It's the latest this morning. US 10-year Treasury yields rising, or rather falling for a fourth day through yesterday as President Trump's tariff deadline adds to demand for haven assets. Russell Brownback of BlackRock calling this, quote, one of the most compelling fixed income opportunity sets in decades. Russell joins us now for more. Russell, good morning, sir.
Morning.
We've seen a bit of a rally in treasuries over the previous few days. What's behind that big wall of demand?
So, we're calling it one of several transcendent influences today that really sort of drive market outcomes, and that is this wall of money that exists today. So you look in the United States, $218 trillion of private sector net worth. When you put that in comparison to the size of the asset markets today, it really is a world where there's too much money and not enough yielding assets. And so that's a transcendent influence in the face of lots of policy uncertainty, that along with a resilient economy.
Everything seems to have settled down over the past few months. There's something you and the team have said, that genuine economic risk is muted. What do you mean by that?
It's this series of structural, foundational influences that have transcended uncertainties that the economy has faced in 2023 with the regional banking crisis, an acrimonious election last year, and the uncertainty about the sequencing of policies and implementation this year. And yet you get these momentary pullbacks of consumption or investment just as velocity slows, as uncertainty sort of cycles through the system. But then it rebounds, and you've seen the economy accelerate into the fourth quarter each of the last 2 years. It's my expectation you'll see the exact same thing unfold this year.
Which is a reason why you've been reducing your position in cash and seeing spread compression through the remainder of the year. I just wonder if the book's really been written on the policies that have been implemented and the policy uncertainty and the ramification on the economy. Why do you think that we have enough information to say we will still see that reacceleration, even if some of those tariff ramifications haven't been fully felt yet?
So again, because these underlying influences are so powerful, these policy evolutions are only marginally, incrementally determinant to outcomes. And, listen, I think markets have correctly assessed the tariff situation as benign at the end of the day. At the end of the day, tariffs are a tax. And so the debate about whether they're inflationary, you think about if we were sitting here talking about an income tax, we wouldn't be discussing whether it's inflationary or not. We'd be discussing its impacts on growth. And so when you think about, and many guests have been on your program over recent days talking about how that tariff impact is spread out over so many different nodes of that value chain between the point at which the good arrives at port and when it ends up on the store shelf. So these are marginal sort of shifts in underlying economic actors and the influences there. But overall, these foundational supports are what's driving markets.
And that's driving credit, that's driving equities. How should this really play through in the Treasury space, given the fact that we have potential rate cuts coming down the pike, even with strength in the economy, and a real question around how much it's going to be an inflationary push over the next 6 months?
Yep. So I think the bond market has found an equilibrium all throughout this year. It's steepened in deference to slowing growth and inflation that's still above target, and a Fed that will likely deliver a couple of rate cuts by the end of the year. The front end of the curve is anchored to Fed policy. The back end is anchored to nominal growth. And if you think about a 4.5–5% nominal growth outcome this year, that's exactly where the bond market is today. We see this fixed income regime as one where there isn't a big interest rate bet to make. It's about clipping that coupon. It's about the income associated with the fixed income opportunity.
Is that another way of saying this Fed conversation is not that relevant?
So, listen, I actually think the debate that is taking place today is a healthy one where there's credible arguments on both sides. Don't cut or cut. I happen to be in the camp that says the setting of policy today is suboptimal. You think about the K-shaped evolution of the economy today. I don't call it a K-shaped recovery because I don't think the U.S. economy is actually cyclical. But the current policy setting today, think about the savers, which is really the purview of the wealthy and higher income cohorts today, $150 billion a month of interest income accruing to those economic actors. Low income, low wealth cohort households, that's where all the floating rate debt is today, your credit card debt, your auto debt. And so the policy stance today is simultaneously helping the savers and hurting those lower income cohorts. So an adjustment downward, I would argue, might be a bit more optimal.
On aggregate, a net benefit or net negative? It sounds like a net negative.
To keep
rates where they are.
Listen, the economy, again, these transcendent influences, the policy setting today is not going to dent the trajectory of the economy. It's being influenced at the margin by velocity, which slowed earlier in the year and is set to become unleashed in the back half. I think it would be more optimal if the rate came down a little bit and met where the market's pricing cuts today.
Russell, appreciate your time. Thank you, sir. Russell Brownback there of BlackRock on the credible arguments on either side over the FOMC.
What he just said there about the structure of wealth in this country, I thought was fascinating. The idea that savers are benefiting from rates staying high. And that's at the detriment of people who have to borrow these floating rate instruments to do things like buy cars and cover their credit card bills. That's a really important argument.
Story of the last 3 years.
Yeah, exactly.
It's a problem. It's a big problem. Up next on the programme, Alex Altmann of Barclays, Nishit Madlani of S&P Global, Andrew Hollenhorst of Citi and Space Foundation CEO, Heather Pringle from New York. This is Bloomberg.
The quality of the S&P has actually improved. The valuation, yes, it's high, but it's justified in our minds.
Businesses are still in a really, really good spot.
Corporate America has a lot more difficult decisions to make this quarter.
It's not all easy. I think this is going to be somewhat messy in this reporting season.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
That all sounds dreadful. Stocks are at all-time highs. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now with equity futures just about positive on the S&P 500. On the Nasdaq, the focus on tomorrow afternoon, looking ahead to numbers from Alphabet and from Tesla. In the bond market, yields have been falling coming into Tuesday. This morning, totally unchanged. The 10-year at 4.38. If Mohamed Al-Erian gets what he wants, this market won't be unchanged. He's looking for the chairman of the Federal Reserve to resign.
If it can quiet some of the noise around the independence of the Federal Reserve, he came out and posted on X. He's not in the consensus, let's just put it that way. Adam Posen said that he just was a hard pass to that argument. There is this question, though, about what it will do if you do get some sort of changing of the guard, if the person who is put in that seat is credible, if they have some sort of legitimacy in economic circles.
It's a polarizing take from Dr. Al-Erian this morning, that's for sure. But if one party's happy, it's the White House, isn't it? That's what they're pushing for.
Absolutely, because this is out of consensus with what a lot of individuals are saying. And basically, Mohamed Al-Erian is lining up behind their argument. But he is saying that if Jay Powell himself cares so much about the autonomy and the independence of the Fed, then take yourself out of this equation. Of course, the next question comes, who then do you put into that chair? And I think what Mohamed is saying in this tweet is actually he thinks markets will be fine. But markets will be fine because the move before will be Jay Powell resigning, not being fired.
So this is about institutional credibility. On the institution itself, they meet next week and they conclude that meeting a week tomorrow. Andrew Hollenhorst of Citi joins us a little bit later on this programme. He's pushing the idea that don't worry about tariffs. Rather like what Governor Wallace said to us on this programme just last week, the pass-through to the consumer isn't as strong or as powerful as many people feared.
And that's what we saw in GM. That's what we saw in a number of different companies who have absorbed some of the margin compression that the president has called for. We see Coca-Cola raising prices, but some of the smaller, lower price goods, you're seeing some bigger price increases just because they can do that. If you kick it up 2 cents, it's not going to make a big difference. I will just say, this is a common argument. Even Mary Daly on the Federal Reserve Board talking about the idea, or San Francisco Fed president talking about how she is coming around to the idea that this is going to be a one-time price shock. I keep thinking about what Russell Brownback said, though. I do want to come back to that argument of just sort of who it affects if they lower interest rates.
Also, if the Fed is concerned about where the tariff levels are going to be, the Treasury Secretary saying this morning, August 1st is, quote, pretty hard deadline for all countries. I think what he's saying there is he doesn't mean you can't negotiate after tariffs go up, but they are trying to deliver on all these fronts by August 1st. And in that case, will the Fed have enough information when they meet in September?
This is what the Treasury Secretary's got to say in the future of the Fed chairman. No reason for Powell to step down right now.
Because ultimately they're going to go through this process. What benefit does it do for them? Honestly, they don't want to roil the market. They want a scapegoat. They want to have this discussion. At a certain point, what are they going for? And why are they increasing the pressure if they're not going to have him step down and they're not going to fire him? Again, we keep asking that question. I'm not sure the answer.
Looking forward to the live blog from the White House next Wednesday.
Indeed.
During the news conference with Chairman Powell. All of that's a week away. Right now, equity futures doing okay. Just about positive on the S&P 500. Coming up this hour, we'll catch up with Alex Altmann of Barclays following another all-time high. Nishit Madlani of S&P Global reacting to GM earnings. And Andrew Hollenhorst of Citi on his call for a September rate cut. We begin this hour with stocks hovering near record highs. Alex Altmann of Barclays writing, ultimately, it remains all eyes on that confluence of the FOMC, PCE, NFP, mega cap earnings window with a sprinkle of tariff threats or relief. Alex joins us now for more. Good morning, Alex.
Good morning.
How are we priced for all of that?
Well, the S&P is pricing at about a 1% move every day over that 3-day window. But what's really interesting is that we've obviously had a long streak of really very little volatility. The market's pricing in a 3-day window of volatility, and then it's pricing in no volatility again. So I would say there's still a relatively high amount of complacency, even over those that 3-day window of 3-letter acronyms.
Tariff threats or tariff relief? The difference between the two? What is the difference between the two? Is this a market, do you feel, that's betting against the administration following through or betting on corporate resilience in the face of tariffs?
I would say the latter. It's quite clear. I mean, the S&P is trading on basically at its cap of what it's been trading from a valuation perspective in a post-COVID era, which is about 22 and a half times. And so if we break out of that, we're starting to question if we're getting into a new regime of valuation and of, dare I say, bubble, which is clearly going to be moving towards tariff relief than tariff fear.
Well, but Chris Harvey had an interesting argument about this. You used the word bubble, but he made the argument that we should be getting to higher valuation levels, given the fact that this is a much more tech-dominant index than it has been traditionally. And we have had this huge industrial revolution underpinning some of the efficiency gains that have allowed companies to absorb some of the tariff costs, et cetera, with relative grace. What do you make of that? That there needs to be just generally a higher valuation, a higher multiple put on U.S. equities as a result?
I think that's generally been the path over time. If you look at the path of the equity market multiple post-GFC, as profit margins have increased, you've generally seen an improvement in valuations. I would like to pivot slightly and just talk about small caps a little bit, because we're going to talk about a technological revolution. And we need to start thinking outside the box a bit, beyond just the hyperscalers and the immediate picks and shovels beneficiaries of AI. Let's talk about the fact that consumers get a huge benefit from AI at basically a subsidized cost as a result of these hyperscalers investing, quite frankly, trillions of dollars into this investment at what is currently a low ROI. Think about the consumer benefit. Think about the small business benefit. Businesses that now you're democratizing the process of that AI revolution into, let's call it, small caps. And that's why I actually think the valuation anomaly might actually be in the smaller cap space, which basically has been overlooked for years now.
So this is the argument that people were making last year that didn't really come to pass, that we'd see a broadening out away from the hyperscalers and the big tech names to the rest of the index, because you are seeing that diffusion of some of the tech prowess. Is that sort of what you're expecting now? Is that kind of where you're leaning in?
It is. And also, let's not forget, like, breadth this year has been pretty good. So we've already seen a broadening out. Like, best performing sectors in 2025 have actually been things like industrials. It hasn't necessarily been just the mega caps. But then we've also got to start thinking about a regime shift, which has already been discussed in this forum here, which is, what are the Fed going to do? If we're going to move away from a higher for longer narrative to a lower interest rate environment, consider the fact that small caps, 45% of small caps are variable interest rate debt. They're going to get the direct benefit of interest rate cuts. So we can pontificate about whether Mr. Powell is going to resign or the rest of it, and we will. However, the fact of the matter is that we will end up with a replaced Fed chair at this time next year, and we are pretty convinced that the path of interest rates is therefore lower. So we need to think about less about the near term and more about, if interest rates are lower, who's going to be the direct beneficiary? So it's not just the AI angle. You've got lower interest rates, and you've also got the positioning, which has been our guiding light since the beginning of June. From a positioning perspective, look at CFTC data on small caps. It's currently the most short since last summer, right before we had that big squeeze as well.
Even before we get a new Fed chair, we could see the Fed cutting interest rates. When do you have this all timed out?
Well, so Barclays economists have still two cuts for the year. So, September, December. I think that at the end of the day, whether this is one cut, two cuts in 2025, I wouldn't say it's irrelevant, but I would say it's marginal, because we're trying to sort of forecast. Remember, equities are supposed to be a forward discounting mechanism. They're supposed to be thinking 6, 12, 2 years out, especially for long-dated securities that don't have many profits today. So in that case, I don't think it matters enormously.
So for small caps, you want to be exposed ahead of September?
Correct, yes. I think the small cap story is really not just about positioning, but it's about that Fed pivot, or dare I say, is the equity market moving into a new regime, away from just thinking about the narrowness of leadership and into something a little bit more broad?
Strange things happen in August. Are you hopeful we'll have one of those nice quiet summers?
I mean, I'm going on vacation on Friday.
You're taking some time off.
I would very much hope so. But as you say,
Nice
August is notoriously volatile. August can be notoriously volatile. If we all recall last year what happened with the BOJ and so on and so forth. I would say that the fact is, to your first question, we still have that confluence of events straddling month end, and any of those could potentially derail this low vol environment.
What's volume like at the moment? Just volume?
Volume is okay, but it's massively skewed by the retail cohort. So we're seeing this enormous turnover within a small number of securities as a function of the small investor, which is, again, a part of a larger discussion.
Can I just follow up on that? What securities? Are they concentrated in the ones we talk about every day, or different kind of companies?
I mean, for the purpose, I won't name specific names,
sure.
But I'll give you an example that 4 securities, I think it was middle of last week, 4 securities accounted for 11% of total NYSE volume. The collective market cap of those 4 was 2.6 basis points of US capitalization. So these aren't stocks that you talk about on a daily basis.
11% of volume, 2.6 basis points of market cap.
Yes. Of US market cap.
That's amazing.
Yes.
Have you ever seen it like that before?
We have not, no.
What do you think's behind that?
So that is, I would say, retail euphoria. So you've had this prevalence on shift of obviously a multi-year structural phenomenon post-COVID, where small investors have become a larger and larger portion of the tape. They now account for about 25%. Systematic flows, so quantitative flows, account for another 50%. And those numbers have just been growing over time. So the only time we came close to this was in 2021, obviously a very different real rate environment.
But different backdrop completely. So I'm trying to figure out, just in real time, what's unleashed this recent bout? Because it feels like a very different backdrop to where we were all those years ago.
This goes back to my point of whether are we in a bubble or not, because we're talking about animal spirits, we're talking about euphoria, we're talking about the fact that there's a lot of small investors still haven't lost their jobs, still getting income growth, still basically seeing the stock market at the highs. And if you remember at the beginning of the year when we spoke on this show, there's a reflexivity in stocks. Because the economy is so financialized, 70% of financial household net worth is tied to the stock market. So on the way down, it feels terrible. On the way up, it feels fantastic.
Is this stupid money or is this smart money? Because they've been the winners. And a lot of people used to dismiss this and say it's a bubble and this means that the market's going to tank. Are people looking at this and saying this means there are more gains ahead?
Well, I don't want to call them stupid money because the fact of the matter is they've made more money than most professional investors have recently. I would just simply say that these guys are doing what they've been doing or conditioned to do, which is buy the dip. I think what's important to consider, though, is back to this regime shift. Is the market telling us that we're moving to a lower interest rate environment where actually it's a lot of the less profitable stocks that end up being the market leaders? And if you look at things like certain factor behaviors, the only time we've seen this before, these what be engineered as a short squeeze, but it's not a short squeeze, 2009, 2020 and 2021, neither of which were just short squeezes. They were regime changes. And so I think that's what we're pointing towards. That's why we're thinking about small caps more, because it may not just be the stupid small investor. It may actually be something a little bit more paradigmy.
Those numbers are amazing. 11% of volume across 4 names, which account for 2.6 basis points of US market cap.
Yeah.
Unreal. Alex, good to see you.
Nice to
see you. A lot
see
to think about. Thank you. Thank you, sir. Alex Altmann there of Barclays. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent is calling for an exhaustive review of the Fed's non-monetary policy operations, including the $2.5 billion renovation of its headquarters. In a post on X, Bessent says that significant mission creep may be jeopardizing the independence of the central bank's core mission to set monetary policy. Meanwhile, the Trump administration released more than 6,000 documents related to the 1968 assassination of Martin Luther King Jr. yesterday, despite opposition from his family. The digital data dump includes more than 240,000 pages that had been under a court-imposed seal since 1977. In a statement, King's 2 living children urged the files be viewed within their full historical context. And In-N-Out's billionaire heiress Lindsay Snyder is leaving California for Tennessee. She said both raising a family and doing business in the state is not easy. Snyder said the burger joint still wants to keep a small footprint, and despite growing calls, she says In-N-Out won't be expanding to the East Coast. A bummer for us. That's your Bloomberg brief. John?
She's out. There we go. Yahara, appreciate it. Thank you. That was terrible, wasn't it?
That was so bad.
Up next, the Morning Calls Plus. Nishit Madlani of S&P Global reacting to GM earnings. That conversation up next.
Concerned about earnings. You know, we're scheduled to do what? Low, middle, single digits here this quarter on EPS growth. That's going to be the lowest in about 1.5 to 2 years. If corporations can't hold those margins up, y'all were just talking about the margins from Coca-Cola. We saw margins go down with GM. I think you start to see some of that flow through to the consumer, and you see that weakening in the economy.
That was Victoria Fernandez of Crossmark. The latest on the earnings. More earnings coming up a little bit later. We'll hear from Alphabet and Tesla tomorrow. Equity futures so far just about unchanged on the S&P 500. Negative by 1% on the Nasdaq. Alex Altmann of Barclays just moments ago talking about volume. 11% of volume driven by 4 names. Those 4 names make up 2.6 basis points of US market cap. They are not the names you're thinking of?
They are tiny, they are specific, they are the Reddit posts, etc. But his takeaway from that was really interesting. It highlights the animal spirits and it highlights the conditioning of retail investors to keep buying the dip. And does this indicate a sea change, a paradigm shift, not necessarily dumb money, but sort of a smart take on where things are going and a potential harbinger of more gains ahead?
Record highs coming into Tuesday. Let's get you some morning calls. First up, JPMorgan cutting Lulu to neutral, citing a more cautious and discerning consumer. That stock is down by 1.2%. Your second call from Stifel, raising its price target on Alphabet to 218, seeing upside to the company's estimates. And finally, Citi, raising its price target on Amazon to 265, expecting revenue and operating income to top Wall Street estimates. That stock is higher by about 1/3%. Let's turn back to earnings. GM, seeing a blow from President Trump's tariffs. A big number from that company earlier on this morning. GM is down by 3%. With the details, let's cross over to Bloomberg's Ed Ludlow. Ed, not a great number from that company.
No, but it's the immediate and quantifiable impact of tariffs. So it's a $1.1 billion hit to adjusted earnings, bearing in mind the short period of time that they've had this exposure in time to do the math. And actually, over the range of an annual basis, they see it in the range of 4 to 5 billion. And so GM, like every other industrial American company with exposure to a supply chain that ranges from Mexico to parts of Europe and Southeast Asia, is doing what it calls mitigation. But as you see the stock down 3%, John, this is a story where it actually beat expectations in large part of what was baked in, but profit is taking a real beating from policy, and you can't shy away from that.
Ed, of the big three in Detroit plus Tesla, who's in a more vulnerable position here in the face of these tariffs?
The big three more so than Tesla. I mean, the way that Tesla's always put it is that it's the least exposed to tariffs because of the concentration of supply chain in North America, particularly the USA. However, Mexico is still an issue for Tesla, right? 20 to 25% of components come from that nation. And the way that Elon Musk put it on the last earnings call is tariffs are hard when margins are already low. Tesla, of course, has historically had industry-leading margins. If you call it an automaker, of course, we can debate whether it's valued as a tech company and its future in AI and robotics. But at the end of the day, they're still going to feel a bite, just less so than the Detroit 3.
Ed, appreciate the update. Looking forward to the programme a little bit later. Ed Ludlow alongside Caroline Hyde at 11 a.m. for Bloomberg Technology, about 3 hours away. Joining us now to extend the conversation, Nishit Madlani of S&P Global Ratings. Nishit, welcome to the programme, sir. Let's just talk about the kind of mitigation strategies these companies have introduced over the past few months. What are they doing to navigate the storm?
Yeah, first of all, thanks for having me. Look, like you said, I mean, there's been lots of uncertainty, especially around March and April around tariffs, shifts in trade policy. It just weakens consumer sentiment, and it's created volume volatility. So what they can do, just is specific to companies like GM, where tariff cost mitigation is very important to offset the 4 to 5 billion impact that they're expected to have. So things they can do is try and leverage the duplicative capacity they have. So for example, they've decided to relocate some of their pickups to Fort Wayne, localize production of their battery modules, and just ensure that they have better supply management, because there are suppliers and internal facilities here that can be utilized better within the U.S.
How much can they automate some of this to offset some of the higher costs of labor in the United States? So bring more manufacturing back to the United States and have more robots essentially in the factories?
Yeah, so that's something they haven't quantified, but it's certainly part of the playbook, right? If you look at what's happened in terms of manufacturing efficiency across companies, there has been increasing use of automation. Not to the same scale as Tesla, but it is certainly catching up. And of course, with the moves announced by them in terms of improving their utilization, that's the first step, because by adding about 300,000 units of additional pickup truck capacity within the US, that just helps overall utilization as well.
This raises a question of how they invest in some of the production and moving production to the United States to get around tariffs, while also cutting costs to offset some of the hit that they're seeing from those extra levies. How do you expect them to do this?
Yeah, look, this is one thing where we have a lot of credibility that we've assigned to the company's management team. They have a solid team, great track record, and despite external shocks, they've maintained a lot of discipline in achieving their targets, whether it's pricing or just making sure that inventories are not overbuilt. On a cost standpoint, look, they've mitigated all kinds of cost headwinds through their internal efficiencies. They've made sure that they're not over-engineered. They also ensure that from a supply chain perspective, they're less exposed to bottlenecks that seem to be more of a common issue for their peers versus them. So I think overall, just a better handle of overall execution from the management team.
Are they at some point going to need to raise prices, though, of their auto vehicles?
Yes, I'd say, look, that's inevitable, right? I mean, if you look at the way they've quantified the impact of prices, 0.5 to 1% type increase, we think that going forward over the next couple of quarters with the pressure that the consumer is facing, it's going to be hard to maintain something more than that. But at the same time, GM, Stellantis, Volvo Car, those are the ones that have the largest cost exposure. So our expectation is that we probably won't be surprised to see low single-digit type price increases stepping into next year. And a lot of that will have to be borne by the consumer.
So that's a 2026 story. When you look at all of these automakers, who do you think is weathering the tariff headlines and the 25% levy on the auto sector the best?
Yeah, look, it's early days, right? I mean, we've heard about mitigation strategies. Like I said, GM's positioned itself well to make sure that even though it has a very large impact compared to its peers, they are positioned to offset at least 30% of it. In terms of exposure, obviously some companies have a lower footprint, outside the US, so those tend to benefit. They have less headwinds to combat. But overall, I would say, compared to Stellantis and Volvo, I've seen more progress being made at GM.
Nishit, going forward, do you see a scenario where many of these automakers based in America don't have a presence in Europe anymore?
Look, it is a possibility. A lot of automakers like GM have obviously done a lot of restructuring in that market and focused on just very specific marquee products that they export from here. So I wouldn't be surprised if a lot of other automakers take that stance where they minimize it to their absolute profitable brands, because obviously that's a very expensive area to operate in. So I would think that that's probably the playbook they'll apply, and it obviously depends on political cycles, right? Because product cycles outlast political cycles.
True. It's a good final point. Thank you, sir. Nishit Madlani there of S&P Global on the latest earnings from GM and a whole lot more. We know that the most competitive, one of, if not the most competitive market on the planet is the Chinese auto market, and the future there is clearly going to be dominated by Chinese players. For Europe, I wonder if the same thing's going to happen over in Europe with the Chinese dominating that market too going forward.
Which would be a disinflationary force, which is something that you've talked about, right? Is that what you're going to end up seeing that causes the ECB to cut rates more aggressively going forward? And we're going to hear from the ECB later this week. Let's hear if they say anything about Chinese products coming to the market.
Maybe causes these US auto players to back out of the market entirely.
That's what I'm actually wondering. If you have the 1-2 punch of trade tensions between the U.S. and Europe, and you have cheaper vehicles coming from China, how much does that start to really dominate a European market and transform it in ways that a lot of people aren't really thinking about right now?
Important final point. Products outlast politics, which
Sure.
is why many people on the other side of some of these trade negotiations are saying this is an individual who is done after this term, and potentially we can ride this out because maybe there'll be better trade deals on the table if Washington was to have a changing of the guard.
Once that money starts coming into Washington, that tariff revenue, we'll see if anyone wants to give that up.
They never end up coming out. That's what happens. It happened in 1939.
Saw that over the last few years with China as well.
True.
Up next on the programme, we'll catch up with Andrew Hollenhorst of Citi on his call for a rate cut in September. The opening bow 60 minutes away. Equity futures just turning positive. We're positive here by 0.06%. With an update on your morning movers, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John, just wanted to give you another look at GM. We were just talking about the shares falling 2.5%, booking a $1.1 billion hit when it comes to costs related to tariffs. There's a lot of questions yet to be answered from GM as to whether this is the worst, what things look like from here. But we are selling first and asking questions later. 2.5% decline in the pre-market. Northern Trust, though, those shares are to the upside this morning by 2.7%. Semaphore reporting this morning that the Goldman Sachs CEO David Solomon had a conversation with Northern Trust not that long ago about possibly buying the bank, that they're looking to beef up their exposure to some low-cost ETFs. Those conversations could heat up, according to that reporting. Finally, some other earnings to go through. Philip Morris also reporting earnings this morning, shares falling 4.3%. That's despite the fact that they raised guidance really around their smokeless tobacco products, like those weird little Zyn pouches you put put in your lip that are quite disgusting. But anyway, they fell because expectations were really high. They rallied 50% into these earnings reports, but missed on organic revenue. So investors really catching on to anything they can, and those shares falling. John.
Danny, thank you. Thank you very much for the latest on the stock market. Let's turn to the bond market. US 10-year yields falling. 4 straight days coming into Tuesday. Ira Jersey of Bloomberg Intelligence joins us now for more. Ira, welcome to the programme. It's not a major rally, but it's a rally. We'll take it. Yields are lower. What's behind the move?
Yeah, I think there's some comfort here a little bit that that demand from foreigners isn't completely drying up, and we did hit 5% on the long end, and once we hit that, we did see some liability-driven investors take notice and start to buy a little bit in the long end. Like you said, it's not a massive rally, but at the same time, I think it shows that there's some stability in both the demand and the supply side, at least for now. And we're going into this week where next week we have the quarterly refunding announcement where Secretary Bessent is going to, for the first time, say, hey, here's how we're going to issue bonds. And right now it seems like maybe there's not going to be any new 10-year bonds being created above and beyond what's already expected.
So Ira, with that question in mind, thinking out going forward from here, what's the incentive to push out more issuance along the curve?
Yeah, well, historically speaking, when you go back the last 40 years, interest rates are still relatively low. Not as low as they were, a decade ago, but compared to where they were in 2005 and 1995 and 1985, interest rates are still relatively low. I think that when it comes to how Treasury has to issue debt, it's really where do they think demand is going to be, and you want to issue bonds where and other debt where it's easily absorbable, number one. And number two, you have to think about how is the refinancing of that. So if you only issued T-bills, then you're refinancing that every three to 4 months. And you don't want to be beholden on, what's the market appetite in 3 or 4 months when you have the opportunity to buy, to issue 2s, 5s, 10s, and 30s. So I think that they will keep coupons stable this quarter. We had always expected them to be. But we actually just put out a note this morning that's available on the Bloomberg terminal suggesting that maybe now, because of this policy by the Trump administration, they won't increase the size of 5s, 10s, and everything else until next May, when they kind of have to. Otherwise, T-bills outstanding is just going to grow to a very massive amount.
Ira, just taking a step back, how global is the bond market right now, and how much are the yield moves that we're seeing in the U.S. affected by what's going on around the world as much as the domestic landscape?
Well, foreign investors are still a very important incremental buyer of treasuries all throughout the curve, particularly in the 2 to 5 year sector is usually where central banks and foreign reserve managers play. And then the long end is where pensions and other liability-driven investors tend to see strong demand. So we always talk about things like Taiwanese insurers, for example, wind up being large buyers of long-end treasuries. They're very important, but not as important as they were, say, 12 years ago. 10 or 12 years ago, about 50% of U.S. treasuries were being purchased by foreigners. That's way less than a quarter today, right? So you wind up with things shifting more domestic in the U.S. as savings rates have gone up a little bit, as interest rates are a little bit more attractive. You have seen more domestic buying, and of course, the Federal Reserve, even though they're continuing to shed treasuries very slowly, they still own a lot of treasuries themselves. So they're a much larger, they're not an incremental buyer of the market and a price setter anymore like they were when they did QE, but they still own a fair share of the market.
Ira Jersey of Bloomberg Intelligence. Ira, thank you. If the Federal Reserve wanted us to stop talking about the Federal Reserve, this is how you do it. You host a conference on the integrated review of the capital framework for large banks. What a name they came up with over there, eh?
Sounds scintillating. I'm excited to hear about what they come up with on regulation.
Expecting Chairman Powell to take the stage any moment from now to address the integrated review of the capital framework for large banks.
What does that even mean? I mean, it's sort of vaguely, we're going to look at bank stuff and balance sheets and anything other than what everyone keeps talking about.
If there is some Q&A, and I don't know if there will be any, but if there is, this is still an opportunity to ask about the obvious.
Yeah. Will you step down? Do you plan to resign? He'll say no. They'll say, do you feel like this is compromising anything that you do at the Fed, the fact that every single day you get an ex post or a truth? And he's going to say no. And then people are going to struggle to ask the same question 15 more ways.
And they would do it all again? next week at the news conference with Chairman Powell after the monetary policy decision. Here's the view on Wall Street this morning. Andrew Hollenhorst of Citi writing the Fed remains on course to resume rate cuts in September. Andrew joins us now for more. Andrew, good morning.
Good morning.
Why September, and what's leaning in that direction already?
Well, I think there's kind of a fundamental argument around September, which is the slowing that we've seen in core inflation. We still have tariff effects upcoming, but services especially look like they've slowed down. Labor market looks strong, but beneath the surface, there are some details that look a little bit concerning. You'd want to be moving towards neutral. That's a fundamental explanation. But then there's also just the Fed rhetoric explanation. They've set this up now. They've said we're going to watch the data over the summer. We're going to make a decision in September. In their dot plot, they've got 2 rate cuts this year, 50 basis points of rate cuts this year. That would also make sense with the September cut. So they've kind of set it up for September. You could argue it's going to be premature in September to know how big an effect from tariffs we're going to get or not in inflation. It's not clear that that's really the month when you're going to have all questions answered, but it looks like that's where they're headed.
On the labour market, in their last statement, the labour market conditions remain solid. Can they repeat that line this month?
I think they can still say that. There is a debate about how solid is solid. Some Fed officials have used the word solid. Other Fed officials have used the word fragile. So you kind of wonder, how can a labor market be solid and fragile at the same time? You look at the headline, we're getting 140,000 jobs per month. That's a strong reading. 4.1% unemployment rate. That also looks solid. But then you look beneath the surface and you see those 145,000 jobs. Well, really half of them were in the government sector, and there's probably some seasonal adjustment issue there. You look at that unemployment rate. Part of the reason it's low is because the participation rate has gone down, and that's because some workers are actually leaving the workforce because they're not finding jobs. That doesn't look as strong. So I think there is this kind of coexistence of a top-line number, a headline number that looks resilient, and the labor market overall has been resilient, but then these details that do cause you some concern.
We often say the stock market is not the economy. The stock market's not the economy. We see the stock market doing really well on the heels of earnings by companies that are doing really well. How do you counter companies doing very well with an overall backdrop that you see as weakening, as less favorable, just overall?
Yeah, so if we look at the economic data, you look at services spending. I think goods spending has been very volatile, so it's hard to read too much into that. Services spending, we've been slowing, and that's really been the engine of growth for the U.S. economy. You see that in Q1. I think we're going to see that again in Q2. And that's telling us that consumer demand is slowing down. We have a real mystery now if you kind of look at the data, because we know someone is bearing the costs of tariffs. It could be foreign exporters, it could be domestic firms, it could be consumers. We don't see consumer prices going up a lot yet. We don't see foreign exporters reducing their prices a lot, at least in the data. So then that would say that some domestic firms are absorbing some of these costs. That should be negative, maybe not reflected in what we're hearing so far.
So why do you think that we're not going to see any kind of inflationary pressure that would pressure the Fed and maybe to remain on hold, despite some of the noise that we're hearing from Washington, D.C.?
So I think we will see some inflation. I don't think that's going to end up constraining the Fed in a big way. And that's because the inflation that we're going to see is going to be in goods inflation. Now, if you looked at the June inflation report, you could kind of see it two ways. On the one hand, we didn't have a big inflationary effect. On the other hand, you had a few categories of goods, home furnishings in particular, where you're seeing some of those early tariff effects, and we'll probably see that in some other categories of goods. But the big question, and this is what Governor Waller has really emphasized, the big question is this going to be just restricted to goods inflation, or is this something that broadens? Are we getting broad-based pressure in services inflation, in wages that are going up, and just a general inflationary trend in the economy? There's no evidence that that's what's happening here.
Do we need to have the final rates to understand that story?
I don't think we can wait until we have the final rates. You would like to, right? And that kind of goes back to, is September the right month to be moving? If the objective was to wait until you had all questions answered, they're not all going to be answered in September. Maybe you'll have some clarity on the August 1st, but maybe not, right? Some of these negotiations may continue. And then even if new tariffs go into effect August 1st, we know where those rates are. How much do they pass through to consumers? What is the timeline on that? What's the extent of that tariff increase? We're not going to have all those questions answered.
Say it is just a 10% baseline overall, then maybe some different intricate deals for bigger partners. Do you think companies will be forced at all to pass on to consumers, or they're going to hold what they're doing right now, which is to eat a lot of it?
I think you'll see some of that passed on to consumers. Like I was saying, we're seeing some price increases already, but 10% tariff, that's pretty manageable. I think that's something that firms largely could internalize, and you probably don't see that much passing through into consumer prices.
How anchored are inflation expectations, both consumer-based and market-based?
Yeah, I mean, it depends a little bit on which measure you look at, and then you can really get into the issue of, are you just cherry picking the one that you like?
What do you think is more credible?
Well, University of Michigan is the one that's been all over the place, right? That one's much higher. Now it's come lower again. If you look at the New York Fed expectations, those have been more stable. I tend to look at the market expectations. There are issues with the market expectations, too. I'm not saying that there aren't. But at the end of the day, people are putting money on the line on those expectations. Those are expectations that, in some sense, are a stronger read on what people really think, what investors think about inflation. And those have not moved to levels that are concerning.
Right now, I'm looking right now at a market that has just defied all expectations when it comes to looking through all of these ramifications. What are you looking to hear from the Fed next week?
Well, I'm not sure that we're going to get a lot of new information from this Fed meeting. We know that we have a pretty big division across Fed officials. We have some that don't want to cut it all this year. We have others that think you should be cutting in July. That's one interesting element of this meeting. We could get a dissent from up to 2 governors. Governor Waller really sounded like he is planning to dissent at that meeting. We'll see if he goes through with that. That's really notable. We had a dissent from Bowman in 2024. Before that, you have to go back to 2005 before you had a governor dissenting on rate policy. So that would be kind of a signal that there's a pretty big division across Fed officials. I think what we'll hear from Powell is wait and see. We're waiting to look at the data over the summer. We're going to tell you in September.
He's got to acknowledge the split on the committee, Andrew. I don't think he can get away with going into the news conference to attempt to reflect a consensus that doesn't exist. There's clearly a division. You see that in the SEP. You see that in the speeches from all the Fed officials. How tricky is that going to be in the news conference?
Yeah, I think this is very difficult, right? This is very, very difficult time for the chair when you have even your governors, right, that are maybe at odds over what the Fed should be doing. So I think what he does is he goes back to the data. That's what Fed officials typically do and say, that's why we're waiting, and that's why we're watching in July and August. And honestly, probably hoping to some extent from Chair Powell's perspective that they will get a clearer signal. It goes back to what we were discussing with the labor market, with the inflation data. You can read this data a little bit 2 ways, and that's part of why there's a division. Maybe we'll have some more clarity in the data by September.
Andrew, appreciate it. Good to see you. Andrew Hollenhorst there of Citi. Deutsche Bank's Matt Lazzetti said it a few times, came on the show and said it. This is not uncertainty. It's division at the Fed that the chairman needs to address.
And honestly, it's something that you would expect at a turning point in an economic cycle. You would expect people to interpret it differently. People on Wall Street interpret it differently. How does he do this while still remaining the position of chair who's setting the tone on a Federal Reserve that is increasingly fractured?
That news conference a week tomorrow. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Coca-Cola reported second quarter sales growth that beat analyst estimates as consumers continue to pay higher prices for its soft drinks. And because of that, the company raised its full-year growth outlook. Coca-Cola also confirms what President Trump posted last week, that it will launch a new product made with cane sugar this fall. Meanwhile, the owner of the Los Angeles Times says he will take the paper public over the next year. In an interview on The Daily Show with Jon Stewart, billionaire Patrick Soon-Shiong said the move will allow the public to have ownership of the paper. If he goes ahead with an IPO, the LA Times would join the New York Times and News Corp among the largest publicly traded news organizations. And Citi is asking its first-year analysts to disclose whether they've already accepted a job offer from another company. According to a memo seen by Bloomberg, the change is intended to, quote, foster a fair and transparent environment. Goldman has made a similar move as banks look to clamp down on recruitment by private equity firms. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Look ahead through the rest of this week. Plus, the Space Foundation CEO, Heather Pringle, with a look at the booming space economy. That conversation just around the corner.
The hierarchy of goals for the Fed is very clear. Stable prices and full employment above all else, financial stability. So this is all just a bunch of game playing. Once we get the jump in price level due to tariffs, does that transmit into second round inflation effects? And that's what the Fed has to call.
That was Adam Posen of the Peterson Institute. That is the Fed's call. Some people on the committee are ready to make the call. Governor Waller's one of them. Will he stick his hand up in just the next week and say, you know what, I'm ready to go. Let's cut rates?
Probably he will. That was sort of the indication. Will he have company, though? Mickey Bowman, as well as maybe some others as well.
And what will Chairman Powell's argument be? Not to do that. Find out next week. Big tease, huge promo. Federal Reserve decides a week tomorrow. Equity futures on the S&P 500 positive by not even 1/10%. The opening bell just around the corner, 30, 40, 41 minutes away. As we count you down to the opening bell, here's the trading diary. The week ahead looks like this. At 11:15, President Trump meeting with the president of the Philippines. On Wednesday, results from Tesla and Alphabet. Plus, President Trump delivering an address on AI. Thursday, a rate decision from the ECB and earnings from Intel and American Airlines. Plus another round of jobless claims. And one small data point into the weekend, durable goods. Elsewhere, let's talk about this. The Space Foundation out with its latest quarterly report showing global commercial revenue jumping 8% from a year ago to $613 billion. The leading driver, the private sector, which accounts for 78% of the space economy. Government budgets making up the smallest portion of just over $130 billion. Potential catalysts for growth include President Trump's Golden Dome, Elon Musk's Starlink, and commercial spaceflight. Joining us now to discuss is Heather Pringle, the CEO of the Space Foundation. Heather, welcome to the programme. Lots to work through here, but the numbers that jump out to me are the 78% coming from private enterprise. Do you see the private sector doing much of the heavy lifting of the space economy for the years forward and the foreseeable future?
Absolutely. The commercial sector is right now valued at $480 billion for 2024, and that is an 8% growth over the prior year. And when we look at the 12 sectors that constitute the commercial market, we look at position, navigation, and timing, which comprises $231 billion. The number 2 service just behind that is ground infrastructure and equipment, coming in at $123 billion. Both of these subsectors showed a 10% growth over the prior year. So with something like position, navigation, and timing, this is coming into every swipe, tap, and left turn that you make using those global navigation satellite services.
Heather, I'm struck by the fact that, yes, the private sector is the one that's leading the charge into space exploration and space use and the space economy. And yet there's a huge national security component to this, with the likes of China and Russia trying to exploit this whole network, possibly disrupting the United States. Based on your research with the Air Force, your service with the military, I'm just wondering how prepared the United States is for that in terms of government coordination with the private sector.
Well, absolutely, the United States is the number one investor in the global space economy, and this includes all sectors, commercial, civil government, as well as national security. Now, you were pointing out what the United States is doing on the national security side. $49 billion of investment into our national security enterprise. Over 90% of that is going to the newest service, that is the United States Space Force. This is well ahead of what we see. China is investing, for example, on the civil government side. The United States is investing $27 billion in the civil government space economy. China's investing 17%, so we're well ahead on that. You can also look at the launch record. For example, the first 6 months of 2025, the United States is launching at a record 97 already. Launches these first 6 months. China is only a fraction of that, well under 20. So the United States is leading, it's leaning forward, and it's doing a lot to prepare for this. You mentioned Golden Dome as well. This is a huge initiative valued at $175 billion for the entire development effort. It's going to have a large commercial component. They're looking at short timelines. They want capability, whether it's everything from sensing to tracking to intercepting, and the commercial space market is really ready to deliver.
Well, the Golden Dome just locked in $13 billion. They named someone to be a project leader. But this morning, Reuters is reporting that Trump is looking for alternatives to Musk's SpaceX to lead that project. What companies in the private sector could lead that project in your view?
Well, Golden Dome is going to be a national security project led by the recently confirmed 4-star General Mike Gutlein. He'll be here with us today at our program. But to your point about who are the commercial entities who can step up to the plate, there are a number of companies that are leaning forward, delivering capability. This is a multi-layered capability when you look at the totality of what Golden Dome is. It's launch, it's sensing, it's tracking, it's intercepting. And so even if you did take a deeper look at the launch enterprise, there are over 14 companies around the world who can deliver that, 10 different nations. So it's a whole of nation effort, and there are a lot of companies who are able and willing to step up to the plate.
I guess what you're saying is if it's not going to be SpaceX, there will be a company that can fill that role. Do you have a timeline of how long this project can take?
Well, I would say there have to be a number of companies, whether it's SpaceX or others, who need to contribute to this project. The scope of it is so large that it really is going to take a number of companies delivering these different capabilities. As far as the timeline, we are looking at, the president has announced that it should be on a 3-year timeline. So that's looking for capabilities that are out there, that are fairly mature, that are tried and true and existing. So that's what it'll depend on.
These numbers are getting bigger and bigger. Looking forward to tracking this story with you once again. The Space Foundation CEO, Heather Pringle, there on the size of the space economy.
I love the space economy discussions. I've got to say, I love the idea of what can happen there, whether we're all entering sort of an Obi-Wan Kenobi, Yoda world. I mean, honestly, all of the science fiction coming to reality, and how that is a serious threat when it comes to international warfare.
I prefer it when you talk about the bond market.
Yes, this is too existential.
Right?
Maybe that's our next broadcast.
I grew up with a family that watched science fiction. I know that's going to be a shocker to a lot of people.
I'm surprised at that.
Really?
I'm surprised.
I didn't actually watch it, but my father.
You didn't watch TV.
Yeah. He had a black and white one that he pulled out from underneath the piano.
And you were allowed to watch some science fiction.
Saturday nights it was Doctor Who.
There we go. Get the camera back to me. Brahma does not want it on her. Okay, tomorrow, Julian Emmanuel of Evercore. We'll also catch up with Ella Hodger of Newton Investment, Ben Callow of Baird, Republican Senator Bill Hagerty of Tennessee. From New York, this was Bloomberg Surveillance.